We are basically overdue for a 3 to 5% pullback.
We have seen extraordinary support from monetary and fiscal policy.
The data is starting to come in as we've been anticipating, very disinflationary.
At the end of the day, stocks do well in the long run.
The market has priced in a whole lot of bad news and a lot of risks and threats, and we have yet to see all of them crystallize.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Stocks doing okay this morning. Live from New York City. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Looking at the equity market on the S&P 500, just about positive by 0.25%. Deflation in China, the focus this morning. TK, every single data print out of that country at the moment just seems to be fueling some kind of negative sentiment worldwide.
I agree to start there, John, and particularly to start there for the Western world. This is not just about China. It's do we impute their deflation, their disinflation over. John, we don't need a bunch of charts this early in the morning in August, but the vector of deflation and disinflation in China from the beginning of COVID, and boy, they did COVID differently than we did. But I'm sorry, it's disinflationary, and it gets you down to a run rate of a positive 1%, even with the present deflation. Even positive 1% is not good enough.
The divergence across the global economy is pretty remarkable. At the same time, the West, developed markets, Europe, the United States are finding inflation. Lisa, we have deflation in China, and I think as a lot of people have asked this morning, it's the right question. We're in it now. How long is this going to last?
And is this bottom? A lot of people projecting that this might be the bottom of some of the price declines that we've seen in China, which could have a more inflationary period later on. The other point, though, is really important, which is the divergence of different economies. How much does China matter as a disinflationary force for the rest of the world at a time where places like the U.S. are moving away from importing some of their goods, and the EU is trying to be a little more aggressive, at least with some lip service.
And when we have budget deficits this big in the United States, Tom, with unemployment this low.
The budget deficit story is tangible, and that goes country to country, but I think there's been a lot of good work. Justin Wolfers was on with Steph Rule last night with MSNBC, and Brian Setzer of Harvard with some really, really good work. And John, it's real simple. We're micro-analyzing export goods out of China. Enough with the micro details. Look at the bigger picture is what these people are saying.
What time did you go to bed last night?
I didn't go to bed. I did an all-nighter.
Okay.
You know,
Steph
called me up. She goes, I got Wolfers in Michigan on. I said, I'll stay up.
Okay. So you stayed up till midnight?
I did it all nighter. Then
with a cigar.
With a cigar.
Good to know.
Yeah. The Telegraph publishes, and I read the Telegraph in the morning.
Good. Let's get to the equity market. Price action looks like this on the S&P 500. You get the sound effects from that cigar in just a moment, no doubt. We're up by 1/3% on the S&P. Yield to lower by about a basis point on a 10-year, Lisa, 4.01%.
It's a quiet day when it comes to the data front. I am watching at 7 a.m. the MBA mortgage applications in the U.S. at a time where yesterday, or 2 days ago, I should say, 30-year fixed rate mortgages, the rate on that raised the highest since 2000. That's how high we have gotten. How much does that really dampen some of the demand there? 1 p.m. The U.S. Treasury is selling $38 billion of 10-year notes. This matters. Yesterday, there was a very successful 3-year note auction. It actually gave a bid to the market to risk assets, some people have argued. Do we get the same kind of thing with 10-year notes? That actually might be more telling. And we do get some earnings, although albeit it is slower. Roblox and Wendy's before the bell. We'll talk all about whether our kids still use Roblox as much when they actually have other things to do. After the bell, Lionsgate, Wynn Resorts, and Disney. Disney, the big one. I want to hear what they have to say about how they plan to use artificial intelligence to replace some of their storytellers, some of their actors even, at a time with all of the strikes going on. This has been one of the most controversial areas, and I really want to see what they have to say.
Trade of the last 3 years, Dave Portnoy. We'll talk about that a little bit later as well. Do you see that story?
That's ESPN.
How could I miss it? Yeah, exactly.
Isn't that cool?
Yeah.
I don't get it. I'll let you brief me.
We'll talk about it a little bit later this morning. My news this morning is that I've applied for a job at UPS. Some people might be happy to hear that. 175,000 all in.
That banner went out on the Bloomberg yesterday.
Hold up. As a driver?
175,000, yeah, by the end of this 5-year contract.
Don't you need a driver's license first?
I'm going to do that too.
Okay, just
checking. Get it all done, Bramo.
Okay.
Mr. Farrell, you've got to drive on the other side of the road.
There's a sequence of things.
Really?
There's a sequence
You're
of things.
going there?
You've got to work in-house for a little bit, do some package sorting, and then get the US driving license and take it from there.
I can see you on 3rd Avenue.
Larry Adam joins us now, CIO at Raymond James. Larry, don't worry, it might take a while for me to get that gig at UPS. This is the line from Max Kettner over at HSBC. We remain pro-risk. Near recessionary expectations still allow for further positive surprises in the coming months. Is that pool of negativity still there for us to feed on?
You know, look, we think that the market's fair valued where we are right now. I still think that there's some risk in this market in the sense that we think you're going to still see a mild recession unfolding. And right now, I think everybody's just getting overly optimistic on both the equity market and the economy. And I don't think that's warranted because, like I said, there are some signs that we're looking at that still point to a recession by the end of this year.
Even the people who don't think we're going to have a soft landing think the data might look like a soft landing for the next couple of months, Larry. Where on the calendar do you think this starts to turn in a negative way?
I think by the end of this year, the economy starts to go into a mild recession. One of the things that we point to is that what's been holding this economy up has been the service economy. And when you look at some of the anecdotal evidence that's out there, I think you could see it soften. For example, everybody's been calling this the Taylor Swift economy, right? I mean, even the Fed has noted that in their beige book. But believe it or not, today's the last day of her concert here in the United States, and then it goes globally. When you look at theme parks, right, you start to see some softness in the attendance there. So I'd watch, as Lisa said, the Disney's reporting after the close to see if that trend continues. And when I look at restaurant activity, you're starting to see some less activity in restaurants. So again, I'm not looking for a major recession. I think it'll be the second mildest recession we've seen in the post-World War II era. But I do think that you are going to see a mild recession.
Larry, long ago and far away at Alex Brown, you would say to people, calm down amid the fears they have of investment. Right now, there's a fair amount of fear out there. What do you do with big tech if you own it and if you've got a capital gain? Do you have the Alex Brown patience of years ago?
We do. I still do like the tech sector. I think one thing that's been missing in these earnings is that if you look at the NASDAQ, keep in mind that the NASDAQ's earnings bottomed in the fourth quarter of last year. And since then, you've seen a rebound. And if you look in the back half of this year, you see some pretty significant increase in earnings. The S&P 500, on the other hand, that hasn't really bottomed yet. Maybe it bottoms this quarter, but more likely it could bottom next quarter. When you look at visibility, right, AI continues to provide that visibility going forward. And then from a valuation perspective, I don't think people take into account how much tech has beaten earnings on average. When you start to factor that in going forward, tech's not as expensive as people think that it is at current levels. So I still like tech going forward.
Larry, Lisa mentioned AI and Disney. I don't buy it for a minute. I think they got much bigger worries than that. But how do you extrapolate AI over to non-tech companies such as Walt Disney and Burbank?
I mean, I think it's all about productivity, and you've seen how productivity has really been helping with the efficiency of these businesses around the world. And I think that trend is going to continue because with this lack of workers that we have, you got to find a way. You know, we always say that CEOs are going to wait there for workers to come knock on their door. They're going to take care of that. And the way to do that is through AI. And again, that's a very broad term, but technology in general is helping to alleviate a lot of those pressures when it comes to workers. That'll help drive earnings. That'll help drive margins. And I think that's why we're not looking for a big decline in earnings at all, even if we do have this recession.
Larry, just to sort of underscore what you're saying, are you basically saying that a lot of the tech companies could act as havens in this next cycle, even if we get into a recession, that they will continue to perform and they could be the defensive plays at a time of potential stress?
Well, I think if we have a recession, if we do have a market sell-off, which, by the way, I think we're going to have one, right? I mean, you tend to have 3 to 4, 5% pullbacks in a given year. We've had one this year. So I think it's time to have one, and we're in that seasonal time period where you could see a rolling over of the market. I think tech is part of that, but if you look through the day-to-day, the week-to-week, I still think that tech will provide that visibility in earnings, which does give you a little bit more of that haven, if you will, of a fundamental basis for being in that sector. So yes, I still like tech from that perspective.
Where do bonds fit in at a time when people are looking to the supply and the potential for the U.S. Treasury to sell an increasing amount of debt at a time where the deficit is at a level that it's never been when unemployment was this low?
Well, I mean, I've heard these concerns about the market not being able to absorb all this supply, and time again, it's been able to do it, right? In fact, if you look at our expectation that we're going to see a modest recession, I think that takes interest rates lower. In fact, contrary to what a lot of other people think that rates are going to stay higher for longer, we think the 10-year Treasury could get down to around 3.25%, 3.5% by the end of this year. So I think with rates, the 10-year in particular being around 4%, I actually think that's a good opportunity to get into the fixed income market as we sit here today.
Larry, where's your level on 12 months on SPX? I mean, we're seeing some really interesting amendments here. Uber bears who've missed it coming up. But even the bulls are tweaking flat to up a little bit. What's your tone on that?
So 12 months from now, June of next year, we think the S&P 500 is up at about 4,600. You know, coming into this year, we were much more optimistic than most people on the street. But I tell you, a lot of that Uber optimism that's replacing that Uber pessimism makes me nervous right now.
Okay, you talk like a Baltimore Orioles fan. You're a Baltimore Orioles fan. Can you give me an SPX 5,000?
Maybe at the end of next year, going into the following year. But right now, I think we're a little bit more cautious. Again, once we get that pullback, you know, then all of a sudden there's upside in that. And I think, by the way, people have to understand that volatility is part of the fabric of the market. So I actually think that that's a positive if we do get some more volatility into this market.
John, that was a World Series 2024 call by
We'll ask him the question, Larry. Let's ask you a direct question. How does a man get suspended from his job for just stating the facts? How does that happen in Baltimore?
Look, I agree with you 100%. You know, if we all got suspended for that, I probably wouldn't be on your show today, right? We tell the facts, we tell the truth. That's what you have to do.
You've got to pretend that stocks went down last year. Is that the baseball equivalent of what's happening at the Orioles, Tom?
People are out.
Exactly.
You know, for markets.
What's important
Stocks went down last year.
Yeah, the people,
stocks will be up this year. They're always up. They're always high,
the
Tom.
people that grind this out every day in sports, I mean, it's a tough job.
I know.
I faked that. Excuse me. I faked at it, John. It's a really tough job. These guys are grinding this away from their families half the year, and they're getting grief from owners on this.
Larry Adam of Raymond James. Larry, thanks for that. If you're not familiar with that story, we'll go through that story for you in just a couple of seconds, Tom. So you've got this local baseball announcer for the team, the Orioles, and he's come out and stated the facts, which is they have a terrible streak against, Tampa? Whoever it is, and then he gets suspended.
The guys for San Diego do it every day. The guys for the Cincinnati Reds, I've been watching lots of Reds baseball in Cincinnati, Barry Larkin and all that. You know what? They all do it, and this guy does it, and he gets hammered.
It's amazing.
Yeah.
So I had no idea. Apparently the job is to be a propagandist, right? Is that the job?
In the old days, it was understood that you were hugely employed by the team and you said good things about the team. Same in hockey.
And is that still expected of you now?
I guess it is. I didn't know it was.
Isn't that ridiculous?
My favorite part is that he made his comments about their streak at the same time that graphics were showing.
The producers made the graphic.
And 15.
Totally.
The record versus the race. So it wasn't as if this was just sort of like, you know, this random, you know, castigation of the team.
If the New York Jets did this, the only one that could be an announcer for the Jets is Alarian. He's the only one that would, you know.
Mohammed would be negative about it.
He would if he last one day.
I find it amazing. Anyway, that's the latest from Baltimore on the market side and the sports side as well. In about 48 minutes, we'll catch up with Victoria Fernandez across market about 7 a.m. Eastern time to talk about the data still ahead. Tomorrow, the big one. Tomorrow morning, CPI, 8:30 Eastern time. Then on to Friday, it's all about PPI. And there is just a feeling, even from those, and I mentioned Citi a few times over the last few weeks on this matter, Citi expect, Lisa, the data to confirm the soft landing view, even though they don't expect it to confirm it at the end of the year. It's like the next couple of months may well play fun and games with the hopes and dreams of the equity market bulls.
This is the problem with data dependency. And when people say the Fed will just be following the data, because so many people say the data will be a head fake and won't necessarily show a reality that's going to play out over a longer period of time. To the same point that you're making, it plays into the hopes and dreams of this perfect scenario that doesn't really happen.
Poetic this morning. I go to 3 month, 12-month annualized statistics. Japan's in deflation.
As you should.
Japan's in massive disinflation.
China, you mean?
China. Excuse me. Japan too, but
that was the conversation. That was 30 years ago. Different conversation.
No, but Japan's got low inflation. Cut me some slack. The answer's tomorrow. I'm going to look at 3-month data.
No longer the early 2000s, Tom. It is
I forget the decades now.
China in deflation.
I wrote something down. I was married.
Sometimes I wonder.
John, I wrote a thing down the other day. I thought I was married for 30 years.
Wrong decade, Tom.
We're not going to see China go back to where it was. It's a very big component of the global economy. It's a consumer of all metals. But also, I think we've got to be minded by the fact that if we're going to build a better world for everyone, we need to invest in development, so all metals are important. Copper is the most strategic of all those metals.
Always great to hear from Mark Bristow there, the Barrick Gold president and CEO. On the metals market and the situation with China at the moment, the situation as follows this morning. They're in deflation. The country is at the moment, the economy not doing so well relative to some pretty lofty expectations coming into 2023. Here's the price action more broadly. Starting with the S&P 500, we go to equity futures on the S&P, positive by 0.2%. Yields just about unchanged. The 10-year 4.0161% on a 10-year. Inflation data, that's tomorrow morning. Going into it, the dollar showing some strength yesterday. We're unwinding some of that this morning. The euro against the dollar, 109.77. And a lift for crude, Tom. WTI, $83.70.
It's interesting to see, and of course, all of it keyed off the data tomorrow morning. We'll give that to you. When's that, John? 8:30 tomorrow?
8:30 tomorrow.
Usual time.
Onto
Michael McKee
PPI.
will drop by.
You see the oil production figures out of the United States.
Yes.
The projections now.
Yeah.
We're talking like record high crude output.
Record high crude output that can take over from the rest of the world, Saudi Arabia included, at a time when a lot of people had written off this kind of trend.
Government forecast, Tom, could be getting close to 13 million barrels a day.
Yeah, it speaks to the cross currents out there away from the gloom that's out there right now. Sort of like what we saw with Eli Lilly yesterday, which was a bang-up earnings report. This is the conversation of the day on China. Kaiyu Jin is at London School of Economics for this summer. Her book, The New China Playbook, is a definitive and abrupt read on her China. Professor Jin, I'm going to cut to the chase, and I'm not going to mince words about it. You nail it. With a deficit of demand in China, there is an ancient Communist Party calculus of what you do with a deficit of demand. Do those formulas, do those processes still work to boost demand?
Well, the Communist Party doesn't really believe in short-term demand-driven stimulus, so it's taking a very different route from the Western governments. It's still focused on supply. It's about long-term. It's about harnessing resources for the long-term strategic goal of technology and high-tech. So they're not that interested in short-term demand stimulus. They're trying. They're setting the tone, a warm tone for the private sector. But it really is up to the private sector and the entrepreneurs to defend themselves, really.
I spoke years ago to Jean-Claude Trichet about the dispersion, the diffusement of productivity in Europe. How does Beijing disperse the message to boost demand? Do they do it federally out of Beijing, or do they do it city by city, mayor by mayor?
Well, actually, Tom, you mentioned a really important thing here. That's the political economy problem or advantage, if you will. The central government sets the tone, but then it's up to the local governments to implement, apart from the large macro policies. And there's a lot of things that can go wrong in the implementation stage. So even if the central government wants something to happen, it doesn't mean it will be delivered.
Right now, there are reports that the Chinese Communist Party is going after academics, economists, other people who use the word deflation, who talk about the negativity of some of this data. What do you make of that? Does that make it a better situation or a worse situation to really grapple with the task at hand?
No, absolutely. I mean, if there's no transparency on information, on how the economy is doing, actually everybody on the ground knows how the economy is doing, but if the leaders can't see it, that's a real big problem. The question right now is economics need to be the focus. China has totally lost the momentum of the last 10 years. And if it doesn't sooner, then we can't really talk about other things like, security, like social stability. So that's got to be the focus. And like you said, there's just much more control on economic discussions and not enough transparency. And I think it's a huge disservice.
And we've heard there are reports that even business leaders who go to China to have discussions are really managed, and they feel like they aren't allowed to have honest conversations with people at a time where there's some real concerns around the housing industry, another developer at the potential brink of default. What do you make of the inability to have free discourse and what that does to actually grappling with the real issues right now? I mean, I ask this specifically just to build on what we were talking about with the idea that if you do not have a social spending, a social mobility, a social employment, especially for younger people, are we entering a lost decade similar to what we saw in Japan?
The lost decade is possible, but not for the same reasons as Japan, because we haven't seen in China a big asset price collapse. We haven't seen that yet. But I would want to say that people are very clear what's going on the ground. The private businesses, I'd even say the policy institutes and the government at some levels understand very clearly. We just don't know how much the top leadership gets it. So my suspicion is, things are just done. There's policy, there's reaction, there's reality. There could be a big discrepancy. Look, the economy is sluggishly recovering. Even if we can't talk about things openly, they're closed door conferences. Investors make their decisions based on information. So,
Professor, all Americans have a legacy of a certain vintage of how incredibly wrong we got the breakup of the Soviet Union. And we did so because we had the wrong intelligence, the bad intelligence, not enough intelligence. From where you sit in your purview, do we have good intelligence on the political economy of China?
I think by and large, no. It's a very unique structure, how decisions are made, how things are implemented, the divergence of interests within the party. Like we said, the setting up of the strategy, but the implementation, there's, huge discrepancy, and even internal mechanisms of competition, of accountability. All of that is rich stuff. China is seeing a lot of problems and challenges right now, but there are also advantages. It's just that China's entering a new stage. The state needs to step back.
It's a difficult stage. Kay Eugene, thank you for the update. Kay Eugene there of the London School of Economics out of Beijing this morning. It's been a difficult week for the economic data out of China. The trade data was terrible. And the inflation data, Tom, we should call it deflation data, given what we've seen this morning.
And it's a rich set of data. And what I would go is where a lot of people, including Dr. El-Arian, went, which is foreign direct investment into China. The lifeblood of technological advancement of China through joint ventures. And I'm old enough to remember, John, when this was a whole brand new idea, a joint venture between a Western, the British will go before us, a Western company and Eastern. They didn't work out. But the answer is, where's FDI? Our input into China's evaporated.
Well, the criticism, what the criticism has been. Joint venture, you be our partner, and then what happens down the road?
Oh, yeah.
We take your technology,
case
your
after
IP,
case.
we no longer need you anymore. Yeah. And the United States, 20 years later, has decided to do something about some of the investment going into China. But we found out month after month over the last 12 months that this outbound investment restrictions that's going to come out of this administration is going to be a whole lot more narrow than we thought it would be. Secretary Yellen spoke to Anne-Marie down in Washington in the last month or so. AMH has gone missing over the last few days.
She lived in Europe for 2 years, and she thinks she's on holiday for a month.
And Secretary Yellen gave us a strong indication, Lisa, that it would be a lot more narrow in scope. And we're learning this morning that it will be, and potentially unveiled later this week.
Specifically trying to restrict investment in companies in China that have artificial intelligence related to military capabilities and very specific types of computing. So there is something a lot more sort of nuanced here at a time where they don't want, the U.S. doesn't want a total divergence from China, but to curtail some of the competition that people have thought of as harmful.
I think research is in order, and I just think the three of us on the deck there, up 7 floors at the Peace Hotel on the Bund in Shanghai.
Yeah.
Surveillance from Shanghai, from
Is
Asia.
that the pitch?
Would be good. Three of us. We could pick the Bramo Cam if it could get through customs.
Can I just say that surveillance would take on a very different meaning on the penthouse event?
Yeah,
very good.
I'm not sure we'd be able to say that on air, would
Exactly. No, I don't think so. But I do think it's an interesting moment. And I think, we're talking about the deflation numbers. China export prices saw their biggest drop in a decade.
A fifth.
Just amazing.
It's a big move. Marvin Lowe's going to join us shortly of State Street. Looking forward to that conversation. Equity futures on the S&P positive by 1/3% on the S&P 500. In the bond market, yields pretty much unchanged. Your 10-year, as it has been over the last couple of days, in and around 4%. From New York City, good morning. The conversations at the commercial breaks are always better. Sometimes you get south-side calls. You get single-name calls sometimes as well when guests don't think they're on it.
That was gold.
That was fun yesterday, wasn't it?
That was really good.
Yeah.
And then walking off to take the mic, be like, all right, I'm done.
at Deutsche Bank with a single-name call, Tom,
Mr. Saving,
this isn't on, is it?
Please. Mr. Savings, the Binkster believed in the market at the bottom. Don't forget
I agree with that, Tom. It's just a joke. It's all right. You're allowed to make jokes. It's okay.
No way.
Equity futures on the S&P. You would never. Up a third of 1% on the S&P. There's a lift in the NASDAQ. Up a third of 1% also. The Russell, the small caps bouncing back as well. Up by 0.42%. The main event a little bit later on the earnings side of things. The Walt Disney Company after the close. In the bond market, 2-year, 10-year, 30-year, 3-year debt issued yesterday went okay. 10-year debt today, that's when the test begins. 30-year debt, that gets supplied tomorrow coming out of the Treasury. So your 10-year right now going into it, 4.02%. Lisa on a 30-year, just short of 420 at the moment, and down, let's call it, a single basis point.
All eyes trained at the 1 p.m. auction of 10-year notes. I do think this is going to be important because what we saw yesterday, the 3-year note was not the point. That was sort of the appetizer that was just really speaking to short-term yield space, which doesn't really have a significant impact. It went well, and you saw the immediate read-through in the broader market. Just imagine what that means for how sensitive the market's going to be, the broader risk market to 10-year.
Can you see her at a bar, bringing a bar to a complete stop
at 1 o'clock later? Yeah.
With her enthusiasm on the 3-year auction.
I am
changing the network to Bloomberg in the bar.
Turn the Mets
Everybody
down.
stop.
Turn the Mets down.
Get
This is
ESPN
worse.
off. I want to talk about the auction.
They wouldn't
Do
be
you ever do
missing
that?
much. Yeah, that would be good.
I go into gyms and turn the change the
Yeah,
channel.
I actually do that
all the time.
Not
I do all
bars
the time.
at 1 p.m.
Just put my face all over the gym and the promos.
They
And the
must love
surveillance this morning. You believe that, don't you? I do. China, sliding into deflation, consumer and producer prices falling together for the first time since 2020, signalling a worsening outlook for the world's second largest economy. CPI registering its first decline, Tom, in more than 2 years. PPI down for a 10th consecutive month. We've seen this for a while now developing.
It's not the same inflation statistics as we have. The key variant there is pork. I used to make jokes about it, except it's really, really serious in China, feeding people. And they're getting a pork and a food and a chicken disinflation here as well. So it's a number of things linked in together driving the vector down.
Speaking of food prices, Lisa, rice prices. You see that headline this morning?
I did. Rice prices surging, and you have this potential for that to affect a broad swath of land. How do we factor these kinds of things in, especially because people are just basically saying commodities are going to be in the back view mirror, and they're not. I mean, very much, whether it's crude, whether it's wheat, we saw that recently, or now rice.
Just under the radar, Tom. Just creeping up on us.
Not on the radar, but not
move.
to these worlds. I did a lot on this 15 years ago. Thank you to the United Nations in Rome, Italy, that are brilliant on this. And the answer is this is deadly serious, no pun intended. And for certain nations, their answer is we need to fix this now. Rice, when rice moves, it's done 3 times here in recent years, up to where we were in 2008. The answer is when it moves, conversations are had immediately.
Prices the highest since 2008. Well, let's turn to this story. A U.S. plan to limit investment in China will be less restrictive than originally expected. The executive order expected to be signed by the president this week will likely apply only, Lisa, to Chinese companies that get at least half of their revenue from sectors such as quantum computing and AI. All of this according to people familiar with the matter. So if you thought it was narrow a couple of months ago, Lisa, I imagine it's even more narrower to you based on the news we've got now.
Yeah, and you framed it right. There really raises a question of where the conviction is for this administration to really go after some of these bans and institute them in a more meaningful way versus try to make peace with the world's second biggest economy. And that has been sort of the tension underpinning the recent diplomatic forays into Beijing. And it also has a very much political tinge where how do they signal one thing and do something else? I mean, basically, that's essentially what some people are talking about.
Last story this morning, this one. First-year analysts eat your heart out. UPS drivers could make $170,000 a year in annual pay and benefits thanks to a new 5-year contract the company tentatively agreed with the Teamsters Union in the last few weeks. Before becoming a driver, though, here's the caveat. Employees first have to work inside the building as a package loader for several years, and those jobs, Lisa, pay less than are mostly part-time. Now, this is going to be at the end of the 5-year contract, so what's that, 2028 going into 2029, but $170,000 for a UPS driver.
3 things. Coming out of the pandemic, we needed our packages delivered even when everybody else was home. You can just imagine that people are now saying, you need us, you don't have enough of us, so guess what? Pay up. Second thing, we will effectively get those costs in higher rates. And we were hearing that from Lee Klasko of Bloomberg Intelligence yesterday. That will directly feed into higher costs of shipping, which I think is interesting. And the third thing I want to say, who is next? given that wages are rising. The United Auto Workers Union pushing back, proposing $46 billion of raises. I mean, at a certain point, if you want workers, you've got to amp up your salaries. If you want consistency, what does that mean? I mean, that's kind of the inflation story.
Underreported right now, and it was in our conversation with Sean O'Brien of Boston and the head of the Teamsters, is how he became head of the Teamsters. It was a massive uproar, good enough for Hollywood in the movies. He was the underdog, came in, and he won because he went with a little guy at the Teamsters. This was a little guy victory, John, at the Teamsters. I don't know if there's a British equivalent or a European equivalent, but this was an absolutely original triumph of the Teamsters. And there's a massive labor, now what, off of what Sean O'Brien did.
Best take I've seen on this in the last 24 hours. This will be the last contract they signed. Because in 5 years, UPS are going to invest so much in robotic delivery, Tom. So much because who on earth can run a business paying the delivery driver $170,000 on average? It's too expensive. So there is a feeling for some people, and I saw that take on Twitter, and I forget who it came from, so I can't cite them directly, and I apologise to that individual if you're watching this morning. But ultimately, there is a belief that this is a short-term move to satisfy things right now, but Lisa, over the long term, if you've got a labour-intensive business and that's the salary, is your business viable in 5 years' time?
A lot of people are wondering whether this also bleeds through to the service industry, too, where you have seen this, right, where you order on a tablet and then somebody brings it. I mean, all of the efficiencies to try to reduce the number of people that they need to be wait staff.
TK?
I'm just wondering, what's FedEx do? I was in my head. Come on, it's an August pause. I don't start the tang, and my doctor hears me not starting the tang until 7 o'clock. John, what does FedEx do? You're a driver for FedEx?
It's going to be a difficult 5 years, I agree with you. I just wonder how many jobs actually get posted for drivers at UPS from here on out. That's going to be a really difficult job to get.
Yeah, we'll see.
We'll see how many openings there are, and good on them, too. By the way, I'm sure they're exceptionally happy with that, as they should be.
No, we're gonna have to see good reporting there by our team in Michigan. Right now, futures up 13. The VIX comes in from a 17 level, better statistic 15.64. Marvin Lowe knows as senior global market strategist at State Street, watching the ebb and flows of an August. Are we in August doldrums? Are we in the summers that you and I remember in our academic studies? August is weird?
August is weird. I certainly wouldn't say that we're in the doldrums, but keep in mind that we are in August liquidity, and that's for sure. So any of these moves out there, any of these stories out there, it's going to get accentuated. And we've seen the moves even over the last week across all these different asset classes.
What is it about August and China? I remember a few years back, I don't remember if it was 2015, it's like August and China. How bad is this data?
Yeah, I mean, the ongoing joke on Trading Desk always is like, August is when things happen. I always say, be around during the third week. It just contributes to the volatility that's ultimately out there.
We had a guest on a little bit earlier who was talking about short-term demand stimulus and how China doesn't like short-term demand stimulus. And I was sitting there thinking, well, local governments do, don't they? Yeah. And their struggle right now is that they can't lever up. Yeah. So what's going to happen going forward from here? You've got a property market that's seizing up. You can tell me how bad you think it is right now. And you've got local governments that can't lever up to help hit those growth targets. What's going to happen?
Yeah, I mean, certainly the property market took a few steps back again. With problems with again some of the larger property developers out there. That does provide a lot of the collateral for the stimulus that people think is easily put out there, and I don't think it's that easy to put out there. And ultimately, all of the concerns that we're seeing around the property developers also ebbs down to the actual consumers of that property. So, our kind of people that are that generally have bought these homes willing to go down that route again, given everything that's happened. I think it means that the amount of growth and really expecting a quick bounce back, because China has typically put a lot of stimulus into the system during periods like this, might not come the way it typically has.
We talk about the property market. Country Garden Holdings, which is a bigger developer than even the Evergrande Group, has missed a payment, and people are wondering whether they're going to make it in the 30-day grace period that they have left. I'm wondering what disinflation in China or deflation in China means for the inflation picture of the rest of the world. Is there as much of a connection as there has been traditionally, where lower prices in China will drag down prices elsewhere.
Yeah, that's kind of where I focus on the China story. How much of it makes it here? It will have an impact for sure. It'll have an impact on the good side of good side of the discussion, which is already collapsing. We do see broader consumer demand for stuff, if you will, not necessarily services, but for stuff really coming down. That's driven a lot of the inflation discussion. But, the focus from the monetary authorities, the focus really is on some of the stories around UPS, around wages, around the services part of the discussion. And that kind of last mile part of the inflation compression, disinflation, however we want to look at it, could be much harder won than the good side of things, where we do see that demand coming off, and it continues to come off.
Can I go to a kitchen table question?
Of course, it's
I
your
got
table.
a chart of Standard & Poor's 500 and MSCI international indices, whatever the indices, doesn't matter. Back to the 2007, the credit crisis. It's been one big fail for international markets. You're a global strategist. Can you tell American investors to get off the Standard & Poor's gravy train and go international?
You know what? I would look at it from an asset allocation perspective. Certainly, there's more value in a lot of the international markets.
Are you going to get a sharp ratio pop here if you diversify into international?
Not that much. And from a margin expansion perspective, from a company beat perspective, the U.S. is still leading that discussion.
Where's margin expansion going to come from across this equity market, given the UPS conversation that we just had? And I'm going to cherry pick some companies. JetBlue, Southwest, talking about flagging demand domestically, a loss of pricing power potentially, and at the same time we're talking about a labour market that still has leverage. What happens with margins in the service industries?
Yeah, I mean certainly that's probably the correct discussion thinking about next year. This year the earnings estimates were pretty easy. We went in with low single digits. We're going to wind up with probably low single digit losses. It's not, it's within the realm of possibility. Next year we expect 10+% EPS growth, and a lot of that is going to be margin expansion. I think you have to look at the companies or sectors that are able to either have top-line growth and or expand margins. Tech does come to mind, even though valuations are tough. Healthcare, from a valuation perspective, probably makes a bit of sense. And some of the work from our equity team, really focused in on the energy discussion from both a top-line and margin perspective. So I think that's how we approach next year, just really looking at those industries that might have a bit of a moat that they can defend.
Are you worried about losing analysts to UPS in the next couple of years? It's quite a salary, isn't it?
I mean, at those levels, I might not have gone down this route.
Marvin Lowe, Senior Global Market Strategist at State Street. Game-changing, potentially, Bramo.
But that's the point. Nobody wanted to say that their child was training to be a truck driver when they were, like 10 years ago. And now we have no truck drivers. And all of a sudden, that's a big issue. And there's this whole dearth of them. And guess what? They're crucial before you get to the autonomous driving trucks. And who knows whether they'll be cost efficient to actually make it work that means less than $170,000 a year. I'm just saying, it's sort of this reality check of the physical economy. And now it's coming to roost.
And also, to your good point, you take 170, 175, and you knock out 30 grand for benefits. So all of a sudden you're down to a 130, 140 pop out. How many years, John? 5 years out?
In 5 years' time, yeah.
Do the math. I mean, I get it. It's a pop, but it's not that big a pop, when you adjust it for some of the realities.
It depends where you live, TK.
Oh, no, I get it. It's like a pop, but come on, 5 years
money.
out, and you got to... This is a major thing. People don't factor in benefit costs like ECI when they're looking at salaries.
And that is all in, and you're right to point that out. Yeah. That is all in.
Yeah.
It includes benefits. 7:30 Eastern Time. Mark Cabana of Bank of America coming up shortly. Marvin, thank you. It's good to see you. Your equity market on the S&P 500 positive by 0.25%, live from New York City. This is Bloomberg.
Inflation does remain too high. There's still a plausible story out there that inflation normalizes in short order and the economy dodges additional pain. There's a lot of talk over the last few weeks about the potential for what is often called a soft landing. Certainly last month's inflation read was a good one, and I hope it's a sign. Because, to be sure, the Fed's objective is not to cause a recession. It's to reduce inflation, in line with our mandate.
That was Tom Barkin there, the Richmond Fed president, does not have a vote this year. Patrick Harker of the Philadelphia Fed does have a vote this year, and he indicated a similar thing. They're embracing the prospect of a soft landing, and Tom, we might be on the flight path to one this year.
I still don't know what a soft landing is. I just, how many times have we gone through this? 3 times, 4 times? V-shape, all this other baloney. Soft landing, what is it? Just describe what it is. I guess they're looking for, what Greenspan would call quiescent inflation, and not a 6% unemployment rate. Put it in the pieces is better than
in simple
whatever
terms,
in God's name a soft landing.
A return to 2% without a recession. In very simple terms.
I'm going to listen to Vice Chairman Clarida. He says, maybe not.
Except 2 point something.
2.x.
I think the Fed's view on it is precisely that.
Yes,
the Fed's view is, can we sit here and be convinced we are on a path back to 2% without a recession and then back away? And will we call that a soft landing and dance around Jackson Hole, Wyoming, and run around clapping hands, Tom, and, doing high fives?
I agree, but we're going to be at Jackson Hole in the bar.
That's what we're going to do. That walk. You're going to do a high five, well done.
Woo, yeah.
Way too early for that.
You and I will be sitting at the bar, and
job, Jay.
Fed president's next to us, and
then they start whispering.
And John's taking notes, and this is how it begins. Right now, we're going to go technological here. Mandeep Singh joins us, senior tech analyst at Bloomberg Intelligence, on all sorts of things that are out there right now. How do you, as the adult, not only in the room but in the building, how do you respond to the idea we're going to keep AI out of China? It sounds, to me, as a complete hack, it sounds completely sophomoric. How does an adult respond to that political statement?
I mean, look at how all these large language models are built, right? They are scraping all sorts of open internet data, that's available on the web. In the case of China, they monitor everything. In fact, they restrict your ability to even scrape any type of data to build, a large language model. So I feel now that they have realized that, obviously generative AI is the new big trend, they're trying to catch up. But in terms of what they have done so far, clearly, I think data is an issue. Then the export restrictions when it comes to getting the latest equipment, that is an issue. And so they're clearly a few years behind when it comes to especially this trend of generative AI.
We're talking about generative AI ahead of the Disney earnings after the bell, and Tom thought that I'm making too much of this, but I know a lot of people who work in the industry who are thinking about, does this mean that their job will be in jeopardy? If you're a backup actor, does that mean that you're going to sell your image to someone they can use in perpetuity and that you just can sit on the couch and do nothing? Are we looking at that type of AI future?
I mean, content IP really matters when it comes to generative AI because all you're doing with generative AI is making it easy to do permutations and combinations and really come up with new sorts of content that leverages existing content. Remember, generative AI is built on training data, vast amounts of training data. Where do you get this training data from? It's coming from existing IP. So anybody who owns existing IP, whether it's Disney or someone else, they definitely have an advantage because that's what is going into training. I mean, you could argue, why are these companies leveraging my proprietary IP for training their algorithms? And I think there is a case to be made.
We're talking about the reality of artificial intelligence at a time of increasing labor power. And we were talking about the potential for automated truck drivers and things of that nature, automated trucks. How close are we to that type of reality at a time when you still have ride-sharing services that are very much dependent on the humans that drive them?
I mean, clearly the large tech companies are investing, whether it's Amazon through Zoox or Waymo. I mean, we know Tesla has ambitions in that space. So clearly they've been burning a lot of cash and investing in it. And look, these things take time. I mean, generative AI was in the works over the last 5 years, and then it had an inflection suddenly. So to my mind, the key to this is training the algorithms, getting that 99% accuracy or even more. And that's what will take us there. And it's not going to happen, over a weekend. It will take years. And I think there is incremental progress right now. Clearly, when it comes to marketplaces like Uber, Lyft, their entire business model is built around supply acquisition. Well, guess what? That supply acquisition is worthless if you have autonomous driving. So those business models could be completely disruptive if and when we get there. And I think that's what market is watching out for.
Autonomous driving on the FDR.
Yeah, can you imagine that? Yeah, okay. I'll be pretty nervous about that. It's getting expensive, Mandeep. I've got to say, Uber, it's getting pricey, isn't it?
Not with Lyft, though. Not with Lyft. Last night they said their pricing is going down 5%.
So I need to switch to Lyft, is what you're saying.
That's their play right now, that they're lowering their prices so that they can bring back the volume. And I think that's a struggle they're having.
Do Lyft grade you? Do they give you a rating?
Yeah.
In the same way that Uber
they
do.
They're commoditized services,
Really?
you know.
Well, I've got a good rating. I just hate being graded as I get in the car.
Because you feel pressure when you walk in.
No, I just, I am who I am, and I'm 496, and that's good. And I'll take that.
I have
you want 5, and part of you bothers you.
No, I just don't want the feeling.
Perfect.
I'm going to behave the way I always behave, whether it's a yellow cab or an Uber.
Yeah.
But I just don't like being a consumer of a good or a service and being rated at the same time. But
I have a
just my
half-star
view.
rating.
Your rating's terrible. Let me tell you what happens when you get an Uber with this guy.
I've seen the other side of it. Well, there's this.
Chevy Suburbans aren't big enough, right? There's a particular model that you don't like. What model is it?
The newer ones I hate.
The newer models. Okay, so if a newer model pulls up, doesn't even say hello to the driver, opens the passenger side door,
Got that right.
gets in, yanks the chair forward, criticizes the new car and says the older model was better, gets in the back, doesn't even say hello. And every time we do anything together, I have to apologise on behalf of us both.
So will you ever get
every single time?
This is the key. Will you ever get an Uber on your credit rating?
No.
With Tom?
Absolutely not.
Okay.
Never.
I mean, that's something it's a consideration.
Question in here to
order the car.
On radio and television, Mandeep Singh. I want to talk about Bertrand Sigwin, who's got an app economy insight. Lighten it up in your world of technology. He's got a chart today on cloud percentages. Amazon, Microsoft with a little bit of an upslope, Google with a good upslope. Do you just assume it's a triopoly 5 years out? Because IBM ain't getting it done.
Yes, I think these are the companies that are spending the most when it comes to building the infrastructure for cloud, and clearly that's an advantage. But I wouldn't rule out, likes of NVIDIA coming out and,
NVIDIA doing the cloud?
Doing the cloud, because they could get disintermediated. If Amazon is developing their own TPUs or their own chips, or Google is doing the same, then they could get disintermediated down the line. So they are better off, going vertically up the stack.
I was disintermediated out of Uber.
Mandeep, thank you. Mandeep Singh.
It's true.
Of Bloomberg. I'm with Lisa. I'm looking forward to these earnings from the Walt Disney Company a little bit later. And the path forward here on the AI front for programming and for media is absolutely fascinating. And I would argue, Lisa, it's been going on for a long, long time. If you think about how they developed House of Cards on Netflix years ago using big data, this has been in the works for years and years and years. And you get to that point where it's starting to climax. Workers start to strike, and this is where you've got to make some tough decisions.
So where does the investment go? Who do they hire on the AI front in order to do that? And then how do they bring workers back in the short term who are striking, particularly because they want to understand with some clarity what their revenue stream is, not just from AI, but also from some of the streaming networks. The reruns there are different in terms of royalties than in the cable reruns.
I don't agree with this AI chat in Disney. They're sitting in the boardroom with Iger going, what are we going to do about Barbie? That's all they're talking about. I mean, they're doing nothing else except saying, where's our Barbie? What are we going to do? What's a JV with Barbie?
Yeah.
I'm serious.
And ESPN as well. They'll be talking about that.
Oh, yeah, ESPN's, I agree. You're big on that. We're going to get a brief from you on that.
We are in the next hour.
Yeah.
We're going to have that conversation on what could be trade of the last 3 years for Dave
Dan?
Portnoy.
Is that what you think? Is that what you think? Hold on a second. Is that what you think?
That's what they do.
I'm sorry, Grandma. What did I do?
They sit around Barbie.
No, they're like, Barbie brought in $1 billion. Where's our Barbie? Somebody's saying there right now. Roy Disney's saying there right now. Where's our Barbie?
They will be incredibly disappointed that they don't own that franchise and weren't behind.
And the process to get to that franchise.
I would agree with that, yeah.
I don't think I'm being cynical there. It's just Hollywood history.
But how many Marvel movies
I mean,
have they got in the
people
pipeline?
all over globally, people are going, where's our surveillance? They do that every day.
Yeah. Is that what they're saying in the boardroom? Where's our surveillance?
Where's our surveillance?
Even you're not saying that seriously. They should be. Victoria Fernandez across Marks coming up soon. Mandeep, thank you. And sorry, all at the same time. Equity futures on the S&P positive by 0.2%. In the bond market, yields just about unchanged. Your 10-year in at around 4%. The runway through the rest of this week. Inflation data tomorrow. Consumer prices. Then factory gate prices, PPI, on Friday. From New York, good morning.
We are basically overdue for a 3 to 5% pullback.
We have seen extraordinary support from monetary and fiscal policy.
The data is starting to come in as we've been anticipating, very disinflationary.
At the end of the day, stocks do well in the long run.
The market has priced in a whole lot of bad news and a lot of risks and threats, and we have yet to see all of them crystallize.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Got everybody sending in their Uber ratings. Only the people who have got ratings at 5, right? Yeah, exactly.
People
Everyone
above
else is
4
like,
and 5.
let's not talk about that. From New York City this morning, good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market is positive by 0.2%, but it's another morning where we have to start today, Tom, talking about the data out of China. Earlier this week, it was the trade numbers, not great. This morning, deflation in the world's second largest economy. Just to compare and contrast there, growth bad, deflation to here, growth good, inflation. It's just amazing to see.
There's some really good charts out there. The FT had a great chart showing 5 or 6 nations, including Japan, with those. I just look at the vector over 3 months or 6 months, and what it says to me, forget about the emotion of deflation. It says disinflation in China, disinflation in Japan as they unroll from YCC. And we don't really have a vector yet. We have sort of a rollover. UK doesn't even have that. They got a big asterisk next to theirs, which is we're going to lose Harry Kane. But other than that, there's the basic idea that we need to still prove disinflation as we go to those numbers tomorrow.
In China right now, there's 2 questions. Can they, Lisa, and will they stimulate their way out of this?
Right. And I think the can they is a key question because people just are not spending the savings that they have. They are saving more. They are not buying properties. And you continue to see that. On a larger scale, this really raises a question of what kind of disinflationary force it is in the rest of the world. On the good side, yes, we are seeing that, and even outright deflation. But then on the commodity side, you're mentioning rice at the highest prices going back to 2008, oil prices, gasoline, all of these types of features that go in that really lead to a separation of the U.S. and the Chinese economies.
Got a great guest coming up, so let's turn to the price action. The S&P 500 positive here by 0.2%. What's that number, TK? What's your rating?
Plus 5.0.
That's not right.
I didn't even know how to look it up.
Okay, you're going to pass over your phone in a minute, and I'm going to find your rating on Uber.
He has
there
a
is no,
5.0
He's
rating?
not 5.0.
Seriously?
Let's get back to the bond market. He's not.
It has an asterisk next to it.
Get back to the bond market. 4.02% on a 10-year. Lisa, in the FX market, euro bouncing back a bit stronger here, 109.78.
All right. Well, we are waiting for those MBA mortgage applications that are supposed to come out any minute. And it comes at a time where mortgage rates are the highest level going back to 2000. I keep thinking of that, well north of 7%. How many people still want to borrow to buy homes? And what price do those homes have to be given how high mortgage rates are? Then at 1 p.m., this is the key event. U.S. Treasury is planning to sell $38 billion of 10-year notes. Yesterday, there was a pretty constructive 3-year note auction. It wasn't that big of a deal because it really isn't the longer duration tenor. That's just because it was the appetizer, Tom. It's not because people didn't care. And the market still responded, which gives you a sense of how they could respond
I'll give
to
you
a
that.
10-year auction.
I saw the response. You're correct. There was a response.
See, it matters. And today we get a bunch of earnings. We just got Wendy's, actually, which looks like it's a bit disappointing, and we can get into that later. We also get Roblox today before the bell. After the bell, really the key thing will be Disney, which has underperformed pretty dramatically this year, up only 1.4% versus a whole host of other companies like Wynn and Lionsgate also reporting today up more than 20%. I really do want to hear what they have to say about AI, investing there. ESPN, we haven't even talked about that yet. Investing more in sports betting. How are they going to pair that with their sort of very pure family-friendly image?
Okay, it's 5.0, but it's Lyft. Uber's deleted. It's erased the app.
Yeah.
Okay, how many times have you used
Uber is
Hold
not
on a second.
on the phone.
Hold up.
That's the second hold
The
on
only
the second.
time I use
wait,
the only time
like,
I
I
use
need
Uber is
grandma
in
this
Paris.
morning is just back
Well,
of the hand.
I'm just, it's a Wednesday, I think. Tom, have you ever used Lyft before?
I use Lyft all the time.
And you've got a 5.0 rating.
I guess I do. I never look. They're so rude to me that,
Okay.
that,
Victoria Fernandez is with us around the table, Chief Market Strategist at Crossmark Global Investments. Victoria, good morning.
Good morning.
Not going to ask you your Uber rating this morning. Going to talk about your price target on the S&P 500. It's amazing for me that we've seen this data come out of China. And typically years ago, what we would have seen on a morning like this morning, through this week, it's just an aggressive rally in the bond market, yields much lower. We'd be talking about China exporting deflation to the rest of the world. What's changed?
Well, I think we have to look under the hood a little bit on this China data. Yes, the headline numbers are down and we're seeing deflation there or disinflation, but the core number is actually the highest it's been since January. It's the food prices in China that brought down that headline number. You had pork prices up 26% in June of last year. They're flat this month. So we have to look a little bit more and see what is driving it. Typically, you would see a response, but I think because that underlying core inflation, which is the concern here in the U.S., what is that core inflation going to look like? Is that going to remain sticky, especially with wages? That's going to be the concern.
I'm so happy you're here. Crossmark has such a pulse on what people emotionally are doing with their money right now. Institutional, high net worth, and the whole thing. What's the fear level out there, meeting to meeting at Crossmark?
Yeah, it's gone up definitely over the last quarter. Each meeting that we have, people are concerned because we've been telling our clients, we think there's going to be some choppiness here. We think we're going to see a pullback in the fourth quarter of this year, so we need to be prepared for that. So they're getting a little concerned. What we've seen as of late, though, is more people wanting to go into the bond market. They see these yields. They think that we're probably at peak or close to peak in bond yields. You know, we were, 4.25% in October of last year. We think that's the peak for the cycle. So if those yields start to come down, they want to add some duration in their fixed income market. So we're seeing that there. But they like the fact that we're being cautious a little bit in the equity market. We're invested, we're in there, we're getting them a good return, but we're being a little bit cautious as to where we invest.
So I just want to go through the chronology of this year. It was, I believe, a soft landing, then a no landing, then it was a hard landing in March. John, you've been very good about documenting the different narrative shifts. You're tracking it. Now we're in soft landing. Do you buy it? Are you basically leaning in that there is this idea, just to use divine soft landing, that we could get back down to near 2% inflation without unemployment rates really rising all that much?
I don't think so. I don't think we're going to be able to have whatever the magic is, the sparkle dust that's going to make that happen for us. I mean, we assume that the Fed, we're close to peak Fed funds rate. Are we there? I don't know. I wouldn't be surprised to see the Fed go another 25 or 50 basis points. When you look at some of the inflation numbers, you look at average hourly earnings over the last 3 months, it's up about 5% on an annual basis. If you look at just the goods producing sector over the same time frame, up 7%. We've got the UAW, their contract ending in September. We could have wages go even higher then. So I think there's some underlying pressure on inflation that's going to continue to be there. And you have an economy that is doing pretty well because the consumer is there, because the labor market is strong. So at some point, we're going to have to pay the piper for everything that we've seen up until now. I think we could start to have a consolidation around a 4,200, a 4,300 on the S&P, take us back another 5%. To us, that's your opportunity to get into the market.
Are you staying away from companies where there is strong labor negotiations or a potential risk there for either shutdowns or a significant increase in some of their compensation costs?
Yeah, I wouldn't say we're staying away. We're not pulling out of those names completely, but we could be a little underweight in those names. And if we start to see more pressure ramp up, especially with the auto makers, then yes, we could come out of those names to avoid some some choppiness.
John, I think this is insane. We are down 6%, Standard & Poor's 500 from the peak of late 2021. We are down 1.5% from the recent peak of days, weeks, months ago. I think it's literally August financial media hysteria going on. And I don't mean just TV and radio. I mean print and the whole. We got nothing better to do, so let's talk about SPX down 5 days in a row or whatever.
Yeah, I don't think anyone's suggesting this is a bear market, Tom. We're down like 15,
I think the
20%
tone is out
right
there.
now.
A lot. OMG, it's a bear market.
You think this is really negative?
It's a correction.
You think the coverage of the last week is that negative? I haven't found that.
I don't think at Bloomberg. I think we're just reporting the statistics. I mean, Kriti Gupta is always very negative. But
you're blaming other media organizations.
No, I'm just saying there's a hysteria out there among our listeners and viewers over OMG, we're not going up 2% a week.
You are seeing some capitulation along that line.
How can you capitulate at a negative 1.44%?
Because people have been so positive, and I don't think anything has been priced into this
bull market off of October.
That's exactly right.
Let's compare multiples now compared to the start of the year. Just how much multiple growth has there been?
Well, the gains that we've seen in earnings are all PE expansions, right? It's not the earnings itself that are really driving it. And we're actually in the third month of an earnings recession going on here. So I think we have to be very cautious. It's one of the things you look at. Valuations are too high, especially for the level of inflation that we're at. So we're going to have to see something give, and I think it's probably going to be PEs.
Well, the question we've got to ask is, where does the earnings acceleration come from into next year? Where's that coming from? Who's driving that?
Yeah, I don't know. We're not seeing it, really and truly. Is it going to be more hope? Is that what's going to get us there? To me, that's pretty shaky ground if that's what you're betting on.
So what's your top kind of shift heading into the last couple of months of the year?
Well, we've always been cautious this year, and we've talked about that story, but adding some cyclicality to your portfolio along with some of your more value-focused names, I think is really smart to have that balanced approach. And so I think you need to do that. Have some cyclical names. Look at the finance names. Banks have taken a hit, obviously, just because of the headlines over the last few days, the downgrades coming out of Moody's and then Italy as well. But financial services should do quite well. A Visa, a MasterCard, maybe an Ameriprise, names we own just for full disclosure. But I think you can find pockets. The correlation between stocks is very low right now. That tells us it's a stock picker's market.
I don't care. What I want to know, the reason we had you up here, thank you so much for coming in. Can you explain Astros-Rangers rivalry? I think for people like us, it's like literally a foreign country. Is it a big deal, Astros-Rangers baseball?
It's a big deal, but I'd say it's not as big a deal now as it used to be. But look, Houston, Dallas, there's a rivalry on everything there. So even though we're in the same state, we are worlds apart.
John, road trip, Labor Day weekend, September 5th.
Yeah.
Astros-Rangers, and I think it's near Dallas.
Which is the team that cheats?
Up in Arlington.
Oh, listen to you. Whoa.
I know which the team.
I think it's time for me to go on that one now. It's the ones that won the World Series twice.
Right?
Yeah,
That's right. That's the team that cheats. Okay. Victoria, thank you. It's good to see you.
Thank you for the
I knew that. Victoria Fernandez at Crossmark Global Investments.
You were going to have the second guest in 2 days walk off the set before the segment was over.
Yesterday, Binky agreed with me. I don't think Victoria was going to be quite as nice. Off the mic. If you are just tuning in, welcome to the programme. Here's a check of the equity market on the S&P 500. Equity futures look like this, positive by 0.2%. Coming up in about 48 minutes from now, Darryl Cronk of Wells Fargo to break down this market. Tom, do you think it's been that negative, that pessimistic? I would argue the opposite. I think we've started to see, to what Victoria said, some real capitulation from people who haven't been in this market.
I agree. We're seeing that. But people are addicted on a week-by-week and a month-by-month basis to up, and away. And it's happened coming out of the bull market. To me, the arch question that Victoria and Crossmark, Bob Dole, and all of them have to live every day is, where's the second leg of a bull market? That's a lot harder to find than coming off the gloom of the first leg.
The negativity might be that more people are coming here and saying consolidation. Even the bulls are saying you could see some sort of consolidation, and then you go in and you buy, which isn't exactly particularly negative. I think maybe you're hanging out too much with, some people who might be a little more negative.
I think corrections are a normative function, and in the modern day of finance, corrections feel like a bear market. A bear market's 18% and often 25 or 35% down, and we're worried about a pullback of 1.44%.
Yeah, I hear you.
No, I'm sorry. I think it's ridiculous.
Can you point to someone who is worried about it?
No, I think there's a lot of people out there addicted to the day after day up of the market. We didn't go up today. What happened?
Right.
We were wrong.
Is that the Dow Points crowd?
No, it's not the Dow Points crowd, because they're looking at a 3-year, 5-year hold. But SPX with a
I
male
think
weighting,
people who quote Dow Points are the kind of people that get,
they do
all fired up about 5% moves.
How about people with 5.0 lift ratings?
Them too. It's more fired up about people being fired up who aren't fired up. Mark Cabana, about 20 minutes away on the rates market from B of A, from New York. Good morning.
Every time you get indicted, I like to check the polls, because one more indictment that I think this election's over. But these incredible numbers are the primary reason that crooked Joe Biden has weaponized law enforcement. They rigged the presidential election in 2020, and we're not going to allow them to rig the presidential election in 2024. We're not going to allow it to happen.
The former President Donald Trump speaking in New Hampshire, not exactly backing away from the allegations he's made over the last several years. Tom, those accusations continue, and those criticisms, those insults laid at the president's feet, also laid at the feet of Chris Christie, the former governor of New Jersey. The former governor of New Jersey, Chris Christie, snapping back on Twitter, X. If you have the guts, you'd show up to the debate and say it to my face. We're going to see if the former president even shows up to those debates in a couple of weeks' time.
I do agree. In the last 24 hours, it's gotten a little more testy. There's been some other things I've seen. I can't remember the names, et cetera, out in the social media. But do you agree, John? The pushback meter here has gone up a little bit in the last 24 hours?
Just a bit. That's pretty fiery stuff.
Yeah. I mean, Chris Christie was on fire yesterday. And, of course, the former president speaking as well. I guess I'll address that right now with Wendy Benjaminson in Washington, hugely briefed in our political moment in America. Just, Wendy, very quickly here, when do we see an indictment in Georgia? Is that on the Benjaminson calendar for August?
Yes, it is. It's most likely next week. There were some final subpoenas, we think final subpoenas that were issued early this week, and the grand jury meets, we believe, on Monday and Tuesday. And maybe on Friday. Anyway, we do expect them to come out next week. And the really interesting thing about this indictment is that this is the one in which Trump could not pardon himself if he became president, because they are state charges, not federal charges. But other than that, it is the fourth indictment. And, you know, that clip you showed, he's not wrong.
Wendy, I think beneath the radar in August, and it's not beneath the radar, it made legitimate national headlines, was, again, to go to states, state legislatures, state judicial systems. It doesn't make for fun and games in Washington, but boy, it's important. And yesterday, Ohio was important. Explain to our audience the immediacy of when a state decides on key national issues.
Well, you framed it exactly right, Tom. I mean, Ohio was hugely important yesterday. What we saw was a rib-rocked red state. This state has been going for Donald Trump and for Republicans for a very long time. And then abortion rights advocates were going to put a measure on the ballot this coming November. And Republicans put a measure on the ballot yesterday for an August election, saying that any ballot measure to change the state constitution must now have 60% support instead of just a simple majority. And voters turned out in Ohio to stop that in numbers higher than in the 22 election, when the governor and the Senate and House members were on the ballot. This time they turned out in massive numbers and defeated it by 57%. So all that means at this point is that the abortion measure will be on the ballot in November. But it wasn't, anti-abortion people who were showing up for that. So it shows that there are these chinks in even a, fully Republican state when it comes to certain issues. And that could be one thing that, could hurt Donald Trump later.
Wendy, I want to go back to this point where we are hearing a definite tone shift among the Republican candidates to be the candidate for president, basically increasing pushback against the former President Trump. We heard that from Ron DeSantis saying clearly Biden is the president and won the election. We hear that every day from Chris Christie. Why the substantial shift? Why suddenly are people saying we don't care if we lose voters, or, you know what, we have to go this route even if we do?
I think it's the latter, Lisa. I think it is that they are saying they are not moving in the polls by being supportive of Donald Trump. They must distinguish themselves, and they have this debate coming up on the 23rd, which Trump may or may not show up to. And if he doesn't, they get 2 hours to make their case to the American people and distinguish themselves in some way. And so far, supporting Donald Trump has not done it. I mean, Chris Christie, as you pointed out, is the most ferocious against him, is the toughest attacker. I'm not sure how that's resonating with Republican voters, although he is inching up a bit, and it would certainly help him in the general if he were to win.
Last night, the New York Times put out a report about this secret memo that has been revealed in one of the recent allegations against the former president about January 6th that actually lays out a strategy of how to basically win an election, regardless of whether there are the votes behind it. Does this change the game materially?
Well, I don't know that it will change the minds of the people who already believe Donald Trump when he says he is being persecuted for political reasons, although it really is rich in detail, laying out the strategy and what Jack Smith, the special counsel, calls a conspiracy in legal terms to overturn the election. There was a memo laying out, let's get the fake electors going, let's have them vote for Trump instead of Biden. And yeah, the Supreme Court will probably overturn it, but by then it may not matter, which is really sort of surprising to hear, lawyers for the President of the United States saying this. And they lay out the plan to request Mike Pence to overturn the election once he gets to Congress on January 6th, which, of course, we know he rejected out of hand. But it is a very detailed, very rich memo that pretty much lays out the plan that Trump accepted, apparently, because it all happened, right, except for Pence overturning the election, and certainly strengthens Jack Smith's case against him for conspiracy.
Hey, Wendy, on the latest down in Washington, thank you. Wendy Benjaminson there. Pushing ahead to the rest of the week, tons of economic data Thursday, Friday. This note just dropped from Torsten Slog, Tom. I know you've read it as well. High yield spreads disconnected from fundamentals. A lot of people have made that point. High yield spreads at the moment are about 390, 3.9. So 390, Tom, over, which historically is still pretty tight.
Mm-hmm. After you lose money the third time because you're an equity idiot and you don't pay attention to the bond market, you start really paying attention to the world of Bramo. And this is a conundrum, as Mr. Greenspan would say. Right now, bonds are priced to perfection, price up, yield down, and that brings that spread where it is, Lisa, doesn't it?
Well, that's true. It also points to a very different market today than 20 years ago.
Fair.
The high yield market right now is a very mature market relative to what it used to be. And you have the smaller companies that are more leveraged, going to private equity firms, going to private credit firms.
What is oil doing, which used to always be the challenge in high yield? Oil would get in the way and make the math not as good. Are they going to private equity?
Well, the oil companies were a big concern in 2014. You saw that as a significant proportion of the high yield index. Since then, because of what happened in 2014, you did see a real decline in the proportion of oil companies that are represented in the high yield market. But overall, they've got better credit. They've pushed out the maturities. And so people are looking at that and seeing fewer defaults relative to the cycle they're expecting.
That maturity wall out somewhere in 2025?
Exactly.
We'll start thinking about that in 2024. Oksana Aronoff of JP Morgan made this point, who's incredibly bearish, I have to say, based on what I heard from her in the last week or so. And Tom, she thinks that if we're not reducing rates by next year, then we start to factor in these companies coming back to the market and what they'd have to issue debt at, compared to what the debt profile looks like now and their borrowing costs. Tom, it's going to hurt. It's going to hurt.
And I have great respect for people like her and everybody we talk to daily here, folks. I mean, these strategists have a responsibility to look out 6 months, 12 months. To us, it's blah, blah, blah. But it's a really tough thing right now. There's just too many moving parts for me to look out to March of next year. There's just too many things going on post-pandemic.
This, to me, highlights the distinction between raising rates to a certain point and keeping them there. You keep them there for long enough, and suddenly these companies are going to feel real pain that most people are looking past right now.
Especially as inflation is coming down. And
correct.
To Williams's point earlier this week, real rates increase. Market banner of Bank of America coming up shortly. Your equity market on the S&P 500. A little bit of a lift, but that lift fades. From New York, this is Bloomberg. Equities positive here on the S&P 500, on the Nasdaq too. On the S&P positive by 0.1%, on the Nasdaq up by a similar amount. Likewise on a Russell. In a bond market, 2-year, 10-year, 30-year into inflation through the next 48 hours. Yield higher by a couple of basis points on a 2-year, 4.77. On a 10-year right now, higher by a single basis point to 4.03%. 4.21 on a 30-year. Supply on a 10-year maturity coming a little bit later on this afternoon. A 30-year, that supply coming tomorrow. Elsewhere in foreign exchange, let's finish on the euro. Why isn't the euro weaker? The question asked by Kit Jukes to SocGen this morning. This morning, Lisa, it's stronger by 0.16% at 109.74.
Although, in fairness, this has been basically the range for a while. I feel like this was the range at 110 for a while. It's 109 now, and it just keeps fluctuating around this exact point with the push-pull of the U.S. maybe, yes, about to end some of their easing or some of their tightening, excuse me, but at the same time, a European economy that's flat on its back and also might be doing the same thing. I mean, this is sort of the sea change. They both might be done.
I'm going to defer to Kit Jukes, as you mentioned, at SocGen and the adults in the room, Jordan Rochester, Namur, the late, great Robert Sinch, and all I did at Bank of America and Bear Stearns over the years.
I think
John,
Sinch is still around.
I'm just going to look at it. Well, I know I'm busting his chops. He's at a hot. Do you know what Sinch is doing right now?
In case he's listening.
Do you know what he's doing? Sinch is sort of semi-FACO retired. He's at a goalie camp.
Is he?
Coaching kids on being a goalie.
Good.
I mean, that's how cool.
Well, I hope he enjoys his retirement.
It's the life of Robert Sinch. I look at 2 standard deviations of euro to your point. I've got here, 111 down to 19, but I got to get to a 107 here to get excited about euro. It's a definition, John, a range bound.
109. As Lisa said, it's been a bit of a snooze. In China, anything but. Under surveillance this morning, China sliding into deflation, consumer and producer prices falling together for the first time going all the way back to 2020. The outlook is getting worse for the second largest economy on the planet. CPI registering its first decline in more than 2 years. PPI, Lisa, falling for the 10th consecutive month.
There are a couple of questions here. Number one, is this the bottom, right? And a number of people have raised this. Number two, what can the government do? What does the government want to do to potentially stimulate or shift this to a reinflation? And then third, what the read-through is to the rest of the world. And this is where you get an increasing number of people saying that the distinction between the U.S. and China has never been bigger, that this is the goods disinflation, but the services side matters that much more, and that's what we have to be focusing on.
Not catastrophic yet. This story is WeWork plunging on concerns about the company's future. The co-working business saying there is, quote, substantial doubt about its ability to continue operating. Let's just frame this. Based on where this closed yesterday, this was a $447 million stock. Lisa, back in 2019, it was valued in private markets at 47 billion US dollars. That is remarkable.
It has faced so many challenges. It's still looking for a CEO. Let's just put that into perspective. At a time when initially they were saying that they could make it through the pandemic with a number of different debt deals, and then suddenly, what's their future if office space is kind of called into questions and a lot of physical employers are creating office space that's WeWork-like in terms of how frequently you can come by, right? I mean, it's not necessarily going to be the same, kind of you have a desk.
Send every bank on Wall Street's like WeWork right now.
I'm wondering whether that's the new model, right? Provide them with drinks in the afternoon.
Drop by, come by.
Drop by a couple times a week.
4 years ago, biggest private occupier of office space in Manhattan and London, just 4 years ago.
Unbelievable.
It's just crazy, Tom, how fast this company's collapsed.
I need the surveillance cork to help me here. I remember walking into a WeWork, 5, 6 years ago, whatever it was, and just going, I just totally don't get it. And, there it was. It was, again, this is all about revenue. We'll worry about profit later. That's the whole game. Doesn't matter what it is. WeWork, name all the other internet companies. Revenue, growth. Baloney.
I think the other issue is right now people have adopted to working from home. So they all have setups there. So they don't have to go to a physical office.
Yes, I'll say the technology caught up with them. Yes.
I do wonder if in 2 years' time people are going to look back on the work from home trends and say, can you imagine people actually thought that was going to be a thing? How many CEOs do you hear quoted saying, it is my biggest regret that I said okay to working from home, letting that genie out of the bag because productivity hasn't gone up?
They had no choice.
And they didn't. That's
there was
correct.
a pandemic. I don't think I'm not going to blame CEOs because I need to show up Monday. But the bottom line is there was a pandemic and now it's over. Now what is the question?
And lifestyles have changed and demands of the worker because of the
We're here every
leverage
day.
they've got.
Our team is all work from home.
We have to be, but others don't
have to be. You could run a bowling ball through the control room. Everybody's work from home.
But Google actually says that working in the office factors into performance reviews. And I love that Zoom. I mean, we talked about this yesterday, but that's just the key.
Work.
Get back to the office. Don't Zoom your way into Zoom.
Into remuneration if you care that much. Want to talk about company culture? I don't either.
One of my top advisors here's Marty Schenker.
Yeah.
When he gets on Zoom, Staten Island dims. He's got that.
Does he go on
he
Zoom?
Has like 35 people on a Zoom call.
Very cool.
It's amazing. It's like Hollywood Squares.
Okay. You don't use Zoom, do you?
Are we still on? Are we still here?
We're still on air,
We're
Tom.
very under surveillance.
We're still on air.
Want to talk about Apple?
We're not going to black.
I want to squeeze this story in. ESPN signing an agreement with casino operator Penn Entertainment.
Yes,
the deal
please,
worth
please.
more than $1.5 billion over 10 years. Penn will launch the ESPN Bet brand in the US, with a casino operator selling the Barstool Sports brand backed by the founder, Dave Portnoy. So Portnoy gets it back after selling gear. Wait for this, for more than $550 million back in 2020. So Portnoy's just absolutely crushed it here. Just crushed it. Now, there is a deal that if there is some kind of monetization event down the road, that Penn's going to get a lot of money out of that deal if Portnoy goes in that direction. But it's amazing how this story's developed. Effectively, essentially, the Walt Disney Company doesn't like brand Barstool, doesn't want to be associated with it. So once you get wind of that, if you're Dave Portnoy, I mean, you're just sitting there and you know you've got them over a barrel, right?
It's like, I'll just walk away. You don't have to do anything.
You don't have to buy it back. They just give it back to you.
Yeah.
Because they want to seal the deal with ESPN and Disney.
And now it's going to be Dave Portnoy unleashed.
Good for him. What a turnaround, Tom. Selling that for $550 million a few years ago and then getting it back for free.
Is a fossil, John. I don't even know what Barstool Sports is, but John, what you can describe it. But what it reminds me of is how I feel about gaming, betting, and that it's all come here. And like Microsoft, Activision, it's a world I don't know, except people I respect say the cash flows are just frightening.
It's happening quickly.
Yeah.
Yeah.
We're just going to move on to bonds, and we do that with Mark Campana. He is one of our favorites here at Bloomberg Surveillance, head of U.S. rate strategy at Bank of America. And the hallmark here is he writes with clarity and avoids BS. And so you lead your note with one of the all-time jargon words of the moment, resilience. Everybody out there, the Boston Red Sox are showing resilience. What a bunch of baloney. Translate your use of resilience to the real world of fixed income.
Well, I think it's a generous characterization of the Red Sox right
now.
But what we mean by this is that the economy has really shown that it has been relatively insensitive to higher interest rates so far. We all thought that we would see the unemployment rate tick higher. We thought we would see fixed investment drop by more. We thought we would see financial conditions tighten more substantially as a result of all of the rate hikes that have been delivered so far and that are expected either in the future or that are expected to remain elevated for a while. And what we've seen is that the economy is really held in. And that has challenged at least some perceptions at B of A about how much we would expect to see the economy turn. Our economists just last week changed their base case from a recession to a soft landing. Now, that's a maybe minor distinction, but nonetheless, it implies less of an upward pressure in the unemployment rate. It implies an economy that can continue to grow for longer, and it implies that the Fed is going to probably have to adjust accordingly. And the way that we think that that adjustment takes place is not necessarily through a higher overall terminal rate, but for a Fed that does indeed remain higher for longer and by cutting slower than the market anticipates. Certainly higher for longer can mean that you hold the terminal rate for an extended period of time, or it can mean that you maybe cut once a quarter, which is now our economist base case, as opposed to the almost every meeting rate cut that the market is anticipating once it gets started.
So would you push back against the people, one after another, who've come on this show and said, we're buying long-term bonds because we think it's great to lock in 4% yields? It's going down to 3.25% or 3.5% on the 10-year.
So we're still reasonably constructive on duration. We do recommend that clients trade the back end of the rates curve with a tactical long bias. You got to respect the range, which looks and tends to be around 375 to 425 now. And we think that because we just believe that long end rates look somewhat asymmetrically skewed to the downside. It's a lot more difficult for us to envision 10s at 5 than it is 10s at 3. And with a Fed that's cutting slower, you're not going to maybe see as significant of a bond market rally. You're not going to see as rapid of a yield decline, but we still think that yields will be moving lower in time as the Fed does indeed move to cuts, but just cutting slower perhaps than the market anticipates.
I want to just ask about the consequences of holding rates at this level for a longer period of time. are people adequately understanding how restrictive that becomes as growth slows and as companies have to start refinancing?
Yeah, it's a great question. I heard your comment earlier about credit and Torsten Slok and what he is saying about underlying fundamentals there. Look, we do think that the credit markets are going to be okay if the Fed ultimately delivers on what's priced for cuts in the forwards, because as you have a lot of maturities that come due, the Fed will be lowering rates, and that's going to soften the blow to some extent. The challenge will be if the Fed does indeed remain higher for longer, and if you start to see some of those refinancings occur at higher rates and see companies begin to adjust how they're going to manage that cost factor into their own calculus. But it's a part of what I think the Fed is looking for. They need to slow the economy somewhat, and they need to ensure that inflation does indeed remain around 2. In our economists' new profile for growth, they do think that inflation just falls slower, understandably, right? You're going to be averaging 2.8% next year, almost 2 to 2.5% in 2025, and the Fed's going to have to move rates slower, allow for more restrictive monetary policy over time in order to ensure that that sticks.
We're tight on time, but the question's too important. Can price give way as yield moves higher? If I look at the Bloomberg Total Return Index, I got a pennant formation. I'm really on support right now. Can price break through that, price down, yield up?
Well, what we think you need to see is that you need to see some type of economic driver for that. We know that supply demand in the Treasury market is really quite daunting right now. You had a surprise from the U.S. Treasury on supply last week. The number one question that we get right now is who's going to buy the bonds? And so what you really need to see is that you need to see the economy provide cover for investors to justify that long duration bias that we've been recommending, that they appear to be holding, especially on the real money side. Thus far, you haven't really had it yet. CPI tomorrow should hopefully move us in that direction, but you really need to see signs of broader economic moderation. And right now, the growth data is not providing that because the economy continues to reaccelerate.
CPI tomorrow morning. Mark, this was good. As always, Mark Urbano, thank you, sir, of Bank of America. If you're just tuning in, welcome to the programme. The S&P 500 positive here up by 0.2%. Coming up shortly, 8:30 Eastern Time, Kathy Bosjancic of Nationwide Mutual Insurance. That conversation just around the corner. Tom, going into that inflation data tomorrow and some PPI data going into the weekend on Friday.
To dovetail Cabana into Bosjancic, John, Atlanta GDP now. I'm not a big fan of the series, but there it is. Are you ready? 4.1%. I didn't frame it. I didn't guess it. I'm looking at the Bloomberg screen at a 4.12%. Whatever the calculation is of Atlanta Fed, that's a boom economy, as Mr. Cabana
there's a
just
risk here,
alluded
Tom.
to.
They back off prematurely. There is a risk that the next few months looks like a soft landing. Their rhetoric, and you can already hear this when you listen to them, that they start to back away and they start to embrace the prospect of a soft landing, which risks, Lisa, a loosening of financial conditions and, to Mark's point, a reacceleration in the economy and reigniting inflation risk all over again.
And you're seeing that actually getting priced into the market. And I'm seeing this increasingly in the break-even rates that we're seeing going forward, whether it's the U.S. or Europe, rising to the highest levels going back to 2008. And this raises a question, okay, are these accurately pricing in people's expectations for inflation over the next 5 to 10 years? Or is it just a reflection of oil prices going up and rice prices going up and basically tracking the commodity cycle? So, these are some of the things people are thinking about when they're trying to determine their long-term call in a sleepy Wednesday.
Big dose of the latter. Big dose of the latter. Then the commodity market's feeding some of this. But certainly the reacceleration in economies is also feeding some of this as well.
Absolutely.
I say economies loosely because I'm talking really just exclusively about America and the United States. Kona Hack of ED and F-Man is coming up shortly from New York City. Good morning.
I'm not a person who pre-declares where I think rates ought to go. I just let the data tell me. We have time before the next meeting and the meeting after that, to figure out whether the various forecasts of where the economy is going come true.
The next meeting on September 20th, that was Tom Barkin there, the Richmond Fed president. Before we get to the 20th, we have some inflation data tomorrow morning. The next inflation print after that is September 13th. In between those two prints, one final payrolls report that comes in early September. Tom, going into the Fed decision just around the corner. And just around the corner is an inflation report which should show, predicted to show on Wall Street, further signs of disinflation.
That's the bet right now.
There'll be some base effects in the mix which push headline year over year a little bit higher potentially, but ultimately looking for further progress going into September. From there is a little bit more unknown. Do we get a reacceleration in inflation? Citi say yes, others say no.
And looking at core, taking out oil and gas and the rest of it and the other trim mean and all that, the breakup here is going to be interesting. I fall back like everybody else to the gossip. What are used cars doing? And all this stuff. And, food, frankly. I hear there's chicken disinflation. There's pork disinflation. I mean, it's out there. You were mentioning Tyson's the other day.
Yeah.
Mentioning disinflation.
The deflation has actually hurt their bottom line. That's the flip side.
And that's a story,
Value
right?
add.
That's a story right now in
Chicken
commodities.
Stock's been butchered.
Sorry, that was just terrible.
It's worse because it's the second time I've made that joke this year.
But it's pretty good.
Hey, this week.
Yeah.
But
Whatever. Same thing.
Different audience.
It's an August audience. Thank you for tuning in on radio and television. This is an important conversation and goes to the heritage of what the world did out of World War II. Out of World War II, there was real worry about food. It was starvation in war-torn Europe. It was starvation in the third world. It wasn't funny. There was some luck in science, in getting better science, better seed technology, and all of that leadership came out of the World Food Program. It was one of the things the United Nations did right, starting in 1961 with the support of the United States and other countries in Rome, Italy. Our next guest lived this. Kona Hake joins us right now, head of research at ED&F. Man, I think a lot of people don't know that, Kona, that Rome is ground zero for food economics, food science. What was it like growing up wrapped around the World Food Program in Rome, Italy?
Well, number one, Rome is the most extraordinary place to be living, and being raised there was an experience like no other. But you're right, United Nations Food and Agriculture Organization or World Food Program, or even IFAD, International Fund for Agricultural Development, it all seems to be based in Rome, and they are transformational in terms of the work they do, not just on economics, fundamental research, but also in policy development and helping the poor, getting the food to where it's needed the most.
We see a leg up in rice now. What does it mean? And I've asked this with respect, I don't mean to pick on Cambodia, but that's always a country I've used where you have a 70% food budget among the people. What does this leg up in rice mean for the countries like Cambodia?
Pretty intense, pretty acute, actually. We're now at the rice prices globally are at the highest they've been since 2008. So this is no mean feat. And it stems from the ban out of India on some of the key rice exports, lower yields out of Thailand because of drought. So the fact that rice is the major staple for at least half the world's population, Cambodia included, means that a lot of people's disposable income is going to be suddenly spent on something that's becoming treble of what they used to pay for. So yeah, pretty extraordinary. Very tight conditions.
Are the disruptions that we're seeing, whether it's rice or we saw the disruption in wheat as well, although to a lesser degree, are they long-term events? Do they have staying power, or is this sort of a one-off that will require some sort of action by a number of nations that have rice that can produce it?
So I would say the first part of the question, rice, it's not too many countries that can produce rice. And the fact of the matter is most of the Southeast Asian countries that produce rice are all seeing some kind of yield decline. So I think that's not going to be an easy fix. On the grain side, however, we do have multiple. So yes, although Black Sea right now is under a lot of geopolitical tensions because of the Black Sea being blocked or under a huge military threat, there are other sources, for example, the USA, Europe, Canada, who can provide alternative grains. And that's one reason why today's wheat prices are not as elevated as they were pre the Ukraine invasion, whereas rice prices have just gone skyrocketing.
So rice is sort of its own story in a different kind of way. On a broader level, I noticed that European natural gas is jumping right now. We're talking about gasoline prices that have been rising in the U.S. We talk about oil prices, which are bumping up past that $80 a barrel, at least traded on the WTI NYMEX. I'm curious from your vantage point whether you see this continuing, that the disinflation in commodities that we saw 6 months ago has reversed.
Yeah, that was our call, actually, that in the second half of the year, we were going to see commodities make a bit of a revival. The premise for this was because we saw the dollar weakening in the second half, purely because US interest rates were going to have peaked by then. So we're seeing a bit of that, money coming back into commodities. But the big kick was really OPEC Plus getting together and substantially making cutbacks. That has fundamentally altered the S&Ds for oil, crude oil, and I think we now know that oil fundamentals are fundamentally going to have to require higher prices, and $80 to me feels like a fair price considering how tight things are. The only caveat, I suppose, is China, the disinflation story you were talking about. I think that's a worrying signal, but the bulls out there will think that this is exactly what is needed to require the stimulus in China, which will then ultimately allow some more demand push for some of these key commodities. Metals in particular is one that has would really be massively boosted if China were to stimulate.
Keene, what's your base case for stimulus out of China? What are you expecting?
Well, I've been really surprised how piecemeal their action's been so far. I think they're worried about maybe their financials in some of the key states in China. I think something's going to have to be done because this level of low export-import and disinflationary trends are not sustainable in the long term. They have to do something to improve purchasing power and confidence. So I feel that something's going to have to happen. It's not just going to be through the rates. There's probably going to have to be more fiscal stimulus, but honestly, I've been surprised how slow they have been in this, and that makes me worried that they're not heavily invested in active stimulus, but at the same time, they have no choice. They have to do something.
Hasn't happened yet. Keene, thank you. Keene Hack there of ED&F Man out of London on the latest in the commodity market. Tom, I think if we didn't have budget deficits the size we have here, if we didn't have unemployment as low as it is here, if we didn't have the kind of GDP figures that you referenced just moments ago, we'd be so much more worried about what's developing in China over the last few months.
Totally agree.
And we're somewhat insulated to it in America, which means the conversation is just so different over here.
How much do we spend on food at home of our budget? We spend 5.6%, just under 6%. Food away from home, and this includes, Ferro, the way you live downtown, we spend 5.6%. We spend about 11.3%.
What's the address?
We spend 11.3% of our budget. Downtown is under 59th Street. It's a broad, broad swath. But the bottom line here is we spend 11, 12% on food. Okay? When we're talking to Keene Hack, we're talking about nations where they spend 60, 70, almost 80% of their livelihood on rice. And we are, to your point on China, we're totally removed from this.
So the politics that goes with that, Tom? What happens next in some of these countries?
Politics is the World Food Program. Right now, it is Senator McCain's widow, Cindy McCain, I believe it is. I'm sorry, mental block there. But Mrs. McCain is leading the U.S. charge in Rome at the World Food Program, and it's something that we've been looking. I did a lot on this years ago when rice went up. And all of a sudden I had to be a rice expert where a lot of smart people told me I was wrong with my American stereotypes.
And then it also raises questions for businesses that are operating in those countries. I think about what happened in Italy, and they kind of tried to reverse course a little bit, I guess, dampen what they did yesterday. But cost of living crisis. Costs are going up.
I'm glad you bring this up.
Tax the banks and give them the money. I mean, it's sort of like there's...
back away a little bit.
John, in one day they're back away, right?
Yeah, just, less than 0.1% of the revenues or something like that, profits.
What's that?
Is that any way to run a country?
Oh, brutal.
No, I mean, we're worse. I mean,
Taking shots at Italy today.
I'm not taking shots at Italy.
Sounded like one.
Where should I go next in Italy? I'm supposed to go to Umbria.
COVID got in the way.
COVID got in the way.
Okay.
Umbria,
yeah.
Umbria. I was supposed to go to Umbria.
Okay.
How about Bari? That's down in the heel.
That's in Puglia.
Down by the Prada logo.
Daryl Cronk of Wells Fargo joining us next. I might not be here. This is
He'll
Bloomberg.
be on one of the 3 islands you live on.
This is not a market for easy money.
The U.S. economy has been resilient. It has proven surprise to the upside over and over again.
I think the economy probably is able to muddle through.
You haven't fulfilled even the 3% pullback yet.
Risk scenarios are that the Fed overstays its welcome here.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio and television. 24 hours, 30 minutes away from the only thing that matters this week. The disinflation report of the United States of America off of China. Deflation, John Ferro. Do we just assume American disinflation?
Most people are, Tom. Citi's Veronica Clark saying that it's unlikely to challenge the building narrative of a soft landing until later this year. So for now, this sweet spot we've talked about where the data looks pretty good, output is strong, GDP's resilient, and inflation shows signs of coming down. Risk assets perform. Then what? Does the Fed back away? Does it keep rates on hold, allow real rates to climb? For how long, TK? That's going to be the story for the back end of this year into 2024.
There's 18 flavors to measure. What I do is 90 days, 3-month annualized. That's just one way to do it, not the best way, not the worst way. I wonder how Jerome Powell analyzes this as he goes from a 9-minute to a 7-minute speech in Jackson Hole.
If he does speak in Jackson Hole, what can he say in Jackson Hole? Can he really draw any firm conclusions, Bramo, around the data we've seen so far, particularly going into the meeting at the end of September, given we still have another CPI print after this one ahead of him? I think we've had a teaser this week from various Fed officials. If you look at the core of the Fed and you go to the New York Fed President John Williams speaking to Bloomberg, speaking to the New York Times earlier this week, speaks to Bloomberg too, don't worry about that. Speaking to the New York Times earlier this week, he made the point, and I think it's an important one to make, it's highly intuitive. As inflation comes down and nominal rates are on hold, real rates increase, and we'll have to do something about that next year. The problem that they're going to have, if they start having that conversation too early, too prematurely, financial conditions start to ease, growth is supported, and inflation can reaccelerate again. That's the risk you're always running. So this is still a pretty fine tightrope to walk.
And you've said, what is the upside for Jay Powell coming out and actually having any conviction whatsoever, any thesis whatsoever on what you could do forward? I got to say, this should be a sleepy August where we're not going to get data that's going to be conclusive, where Fed officials aren't going to give us any kind of guide forward. But it's not. And I feel like more and more guests are coming into the office. I feel like we're seeing this sort of groundswell of concern, to your point, Tom, at a time when are we due for a narrative shift?
Well,
I mean, it's been a couple weeks.
John, I would say I just did this, and I'm not going to do a banner or a chart on TV because it's August. It's too much work. John, you take the pandemic trend of inflation in America, and we've rolled over on core CPI, and we are exactly at 2 standard deviations negative. So this is the reading where if we get further disinflation, you break out of that core statistical study, and someone like Daryl Cronk can go, we have disinflation.
We've made progress. Is it too early to declare victory? We've certainly made progress. You've made progress in the labour market as well.
Nice political illusion.
Job openings down. The quits rate has come in. Tom, we've seen payrolls decrease, deceleration there too. But unemployment is still 3.5%. And that's still 100 basis points south of where they thought it would be only 6 months ago, looking out to the end of the year.
And Crocs whispering in my ear, Tom, you got to go to logs to do this correctly. We're almost there. Maybe tomorrow we'll see 2 standard deviations of disinflation. We're not there. Let me save myself with a data check. John, how about the real yield, 1.66%? In-betweeny is what I would call that.
Equities right now firmer by 1/3 of 1% on the S&P. I remember when Tom and I first started doing this show together, and it just felt like I was talking to myself for 2 hours.
Got that right.
Still feels the same.
They brought me in to remedy that.
So you could share my pain, Bramo.
Right here for you.
Lisa, the 10-year, 4.0262%. Tom, the euro, slightly stronger, 109.73 crude.
It's great.
$83 a barrel.
The tang is slightly stronger today as well. Joining us right now, the adult in the room, Daryl Cronk, with decades of experience at Wells Fargo as their CIO. It's wonderful to have you here. Seriously, I took a big fancy chart and I went to logs on the y-axis, blah, blah, blah. And what it means is the vector of disinflation in place in America? Is it?
It has been, but I'm gonna take the contrarian side of that. I think the second half of the year, inflation ticks higher. I think we finished the year probably closer to 4% on headline CPI than we do 3%.
What about core?
Core probably flat lines here, around 4.5, 4.7. So, Thursday's reading will be probably 3.3, a tick up. It'll be the first time headline inflation goes up in a full year, right? It goes from 3 to 3.3 on year over year. And core probably comes in around 4.7, still way too hot, way too high for the Fed. The problem is in the back half of the year, you lose the comps, right? So you've got, in other words, you need oil prices to be $70 in the back half of the year just to keep CPI flat, right? You already have gasoline prices going higher, as we know. Rents are actually starting to trough and tick higher, right? We still have way too hot of wages, right? So I think the surprise the market's not priced for, and this is why you're starting to see, to Lisa's point, people are coming to the office, they're getting nervous, right? We just printed a 9-month high on the 10-year. Right? You're getting real yields drifting higher. You're getting the 5-year forwards drifting higher, right? Everybody's looking at that. It's causing pressure on your long duration equities. You lost 3 of the 7 magnificent 7 technically that are all now below their 20-day, right? And the NASDAQ sitting right on top of its 50-day. If you lose the 50-day, there's a lot of blue sky below it.
It's going to sound brutal, but nervous about their jobs or nervous about markets?
More nervous about markets, candidly.
Okay.
I think we're overextended here on markets. I mean, look, if you look at
that sounds mean. It wasn't meant to.
you could just
well, if you look at the data, I mean, all of this
excitement.
has been sentiment, right? No question, the sentiment's gotten better. Everybody's improved on sentiment, but the data is not telling the same thing. If you break down even the subcomponents of the leading indicators, the leading subcomponents are still drifting lower, right? So if you just if you woke up from a 2-year slumber and you handed me a package of charts and I started looking at them, I would say, we're kind of on the precipice of probably a tough second half of the year, and you're heading into August, September, October, which is kind of, as we call it, murderer's row for seasonals, right?
It's even more brutal.
Yeah, it is.
Do you want to go sit over by Lisa?
I think so.
Tom made the point on Friday, and I think it was a really good one, that it was the first payrolls report that felt a little bit like a payrolls report pre-pandemic. Is that what's happening here? I saw delinquency rates yesterday coming from the New York Fed. They had some credit card data. And you go through it all, and it says delinquency rates are back to where they were in 2019. Is this just an economy still normalizing back to what we were before the pandemic?
Yes, normalizing, and that's exactly right, but normalizing in an entirely different environment. Normalizing at a 5.25% Fed funds, right? Normalizing in, I sent you guys a chart. If you look at just commercial loans and consumer loans and credit conditions, they are as tight today, right, tightening on a relative basis on a change, as they were in 08, 09, 2000, 2001, and even the pandemic, which actually credit conditions would suggest on commercial and consumer that you're back in an area where the real conversation is soft versus hard landing, not soft versus just no recession at all. So look, I know that's a non-consensus view, right? Everybody comes in here and says the world has turned, it's great. Atlanta GDP now says 4.12%, GDP for third quarter. But remember, that's off of the budget deficit data that came in yesterday, right? That pushed that number hard, right? If you get inside of it and look, what really happened is imports slowed, which tells you demand is slowing, right? So you need to really get in the data and understand it.
So when you talk about people going back to the office, more than you would expect during an August where most people would be going on vacation, what are they worried about? What are they looking for? A technical breakdown just because things are not really factoring in inflation remaining higher for longer? Or is it they're worried about accidents as credit conditions tighten, as people start to see lending tighten on every level?
Yeah, I think in our office, people have their head on a swivel looking for where does that accident come from, right? Because invariably you tend to get it in that tightening cycle. Probably comes, your most robust candidates are going to be your highest leverage candidates, right? It's going to be perhaps a private credit market manager, perhaps an emerging market, right? Something that triggers this. We thought maybe, you saw the Fitch downgrade last week that everybody got a little excited about, right? But it's kind of worked its way through. So I think people are worried most, Lisa, about rates, right, and where rates go from here. Because as you have, I don't know if you saw the data, we now have the Treasury market at $25 trillion. We've got to put away $11.7 trillion of issuance in the back half of the year, right, which is almost half the entire Treasury market, right, that we've got to roll and put away. So all of that's going to put a continued upward pressure on rates, we think, here in the near term. And when the 10-year is above 4%, it's been, in this cycle anyway, breakage points for equities.
So where's the haven?
It's a good question. I think you got to play a little defense right now, right? So if
what
you
does
want,
that mean?
Well, so if you want, so you stay on the short side of the curve on the fixed income side, right? It's not time to fully buy all duration yet. Credit to us looks overpriced, right? We've been favorable all year on large cap over small. That trade's hurt us the last 2 months, but it's been there all year. We actually took down our mid-year outlook. We took tech down to we were favorable on it coming basically multi-years into this and downgraded it. I think you look at healthcare, materials, and probably a combination of energy and industrials. All have greater earnings contribution today than their market cap, which is not true of discretionary and technology. So you look where you're going to get the best earnings protection relative to valuation, right? And those to us make sense right now.
Daryl, this was fun. Kinda. Daryl Kronk at Wells Fargo.
Thank
Slightly
you so
depressive
much.
at the same time, but deeply thoughtful. Appreciate it, as always. Lisa, there's some important stuff in there about how the back half of this year develops. Can you really take the data through the summer and extrapolate it out through the next 12 months? I think most people would just tell you that's extremely risky.
That's what Citigroup is saying. It's the same kind of message, basically, that the year-over-year comps make it likely to see a resurgence in inflation later this year, which could cause some more hiccups. I'm just trying to understand where you park your cash. Is it just cash? Is it the bond stock kind of, 60-40? People saying maybe lead into duration, other people saying not so much. And to me, that's the big thing.
Long end 4%, Tom?
Well, yeah. I think that what Lisa just said that's really, really important. Park your cash is something from over the last 15 years. Right now, you park your cash, you're making a living. And
it depends on how much cash you're making.
You're making a real yield, but we've had outflows from the triple leveraged all cash fund. But can you imagine if we get the BTMM screen to break through to new high yields in the short-term space? How many people are looking for that? I think very few.
True. If you are just tuning in, welcome to the programme. The S&P 500 here.
Plug in there nice, huh?
Positive by 0.25%. Joining us in about 20 minutes' time, we'll catch up with Kathy Bochanczyk of Nationwide Insurance. TK, I hear you. It's an important conversation. If you have a couple of mil to tuck away into cash, you can make a living.
Well, that's what institutions do. But the answer is we haven't had this conversation for 15 years. Daryl Kronk and I were in our ute. And the answer is we're now back to, okay, it's valuable and I'm getting 2x the dividend. Why not park some in cash and wait? There's a lot of people taking their fear of missing out and shifting it over to maybe not.
Lisa wants to talk about Novo Nordisk.
I totally do. That's exactly where I wanted to go.
I know you did.
This is the thing, is that in this market that's totally not correlated, you get these stories, AI, and now it's like weight loss drugs, and all of a sudden the injection providers are getting their stocks bid up, and Novo Nordisk was...
the team on the London desk are talking about the prospect that Novo Nordisk becomes the biggest company in Europe and takes over LVMH.
Well, if this is actually safe and people can take this injection and then lose a ton of weight, then it could replace... I'm not looking at you. I'm just saying that if you could, theoretically, it would have a
massive move
big...
yesterday.
Thank you. Marketable tool.
A weighty move yesterday.
Oh, my God. You're really on a roll.
I'm just bored. What was annoying to me is that we had this rally off the back of data. They'd done some kind of test or something.
I know where you're going with this one.
It said apparently it drops the risk of heart failure and heart attacks and heart disease and strokes and all of that. Yeah, obviously.
You lose weight, and that is a normal
Isn't that just
correlation.
the sequence of things? Did we need someone to tell us that yesterday?
I mean, that's, I think, raising questions around.
I promise I'll call the doctor about it. NOVO space NOR.
Oh, dear Lord.
Yes, dear. I'll call them. Novo Nordisk.
Wegovy? Is that it? Wegovy? What is it?
I don't know. Ozempic?
Is that theirs too? Is that
no,
someone else's?
That's someone else's.
That's someone else's.
That was just like a bleed on.
Okay.
You're both looking at me.
I'm pleased we're prepared for this segment. Well done, Lisa.
I tried.
I think the Fed has the power to get inflation back to 2%. It's just a matter of whether they're going to do what they need to do, and are they prepared to take whatever pain that brings with it. I'm a little more worried about 2024. I mean, my base case is that we do kind of muddle through, but I think if we're going to get a recession, I've always felt it was more likely in 2024 than this year.
Stephen Stanley of Santander on the inflation data. Plenty of debate, plenty of views going into the numbers themselves. We'll get the numbers tomorrow morning. Tom, got that countdown clock ready to go? 24 hours and about 13 minutes away until that inflation data, TK.
The countdown clock is valid here because I'm sorry, not only is it the data of the week, but I'm sorry it has supremacy almost over the jobs report. I've never said that in a million years.
Oh, for this Federal Reserve?
Yeah.
Sure.
I mean, it's a dual mandate. Inflation. Okay, core inflation as well. That's a dual mandate.
And then you look through the labour market and you connect it with
wages and, I get
inflation.
That.
Yeah,
but,
that's the story.
I mean, Daryl Cronk was great. He said, look, wage inflation, it's not come down. Am I right?
Yeah, well, it's come down, but at a slower pace. My issue is, at a certain point, is it really going to matter? Because we're going to get a data point, and it's either going to be high or low, and then people are going to say it doesn't matter because it's going to totally be different, or it's going to be a head fake, and that's basically what we're hearing everybody kind of gear up for right now.
There's a new bias. 12 months ago, it was tell me why I shouldn't hike. 12 months later, it's tell me why I should. That's a new bias on a committee.
That's nicely said.
Thank you.
You can write this
Can I leave?
7-minute speech at Jackson Hole. We're going to get to this. This is too important. It's a 2-hour conversation with Michael Nathanson, Senior Research Analyst, Moffett-Nathanson, expert on Disney. Michael, I'm going to go back a few years to the summer of 2003, where you were a young buck analyst, and you were forced to watch Finding Nemo, Pirates of the Caribbean, Bringing Down the House, and Freaky Friday, all back to back. Disney was riding high. It was a double-digit layup, and it's been the mother of all disappointments. What does Iger do today and in the next 90 days to right the ship?
Tom, he has a long checklist of things he has to fix, right? He has to your content pipeline that you spoke of, it's broken. It will not be 90 days and better. It has to work on trying to figure out why they misfired so much on the film side, maybe changing some leadership there. He has to work on getting ESPN some new partners, as you talked about, maybe finding a partner to invest in ESPN and potentially getting that off his books. He needs to then figure out what to do with his cable networks. Maybe he needs to sell those as well. And he has to work with Comcast to buy in the Hulu 33% stake that is coming to him next year. And he has to worry about DeSantis in Florida. His checklist is enormous, right? So he has a very busy 90 days ahead of him and probably in the next 2 years to fix what he has to fix.
Might be easier to frame the question the following way. What isn't for sale, Michael?
Right. What isn't for sale, John, is the parks, right? Like, I think what's happening here is that the parks are taking over leadership of this company. And as long as the U.S. economy does not weaken materially, the park story should hold pretty well. And our thinking is that this company's in transition from what Tom described as an IP-led company to a parks-led company, right, with streaming attached to it. So I think we're in the beginning of a real transition of Disney's assets into a more targeted company.
Michael, I ask, how long is this going to take? Because there's a leadership question embedded in that. How long will this take?
It'll take the next 2 years, and that's why he's been re-extended, right? They need to make some very tough decisions, which he's hinted about. Our point is, look, we've been negative about linear networks since we started talking to him. The weakness is apparent. It's here. He wants to get the businesses off his books. It's not going to be easy. It's not going to be very accretive to do that. But he needs to get those off his books. He needs to change leadership, in the content side, to fix streaming. It's going to take time. It really is.
When you talk about some of the units for sale, I wonder how the deal that was announced yesterday with ESPN and Penn Entertainment factors into that. This idea that ESPN is going to be going into sports betting, which isn't completely congruent with the sort of family-friendly image that the rest of the parks kind of cater to. Do you think that this is sort of a predecessor to a spinoff?
I think it is. I think they decided the past 2 years that the U.S. perception on gambling had changed, and their perception had changed. This is a deal where ESPN gets $1.5 billion and some warrants, but I do think it's a predecessor to finding new partnerships and trying to reposition ESPN off of their books in partnerships with other companies, right? So, the ESPN's troubles, to me, are not easily fixed. But perhaps you can find some ancillary businesses like gambling, maybe e-commerce. You have to build a new streaming business for them. So I think you'll see ESPN, spinning off of, being spun off of Disney, maybe even taken private the next couple of years. So that could be done off stage somewhere.
When it comes to fixing the content issues on the streaming side, how much of the focus is going to be on artificial intelligence, creating content that is less dependent on some of the talent, the writers, the actors, et cetera, versus just streamlining everything and having a more targeted package and then selling off the rest?
Lisa, that's a really good question. I think in the near term, it's about streamlining. I think they would say, and he said this, that they've just made too much content. They've been stretched too thin at Marvel, Lucasfilm. Pixar has its own issues. But I think in the near term, it's trying to figure out the optimal set of content choices, trying to look at the leadership of some of these verticals. Longer term, the AI question is hanging over this entire industry. It's a potential risk, right? If all of a sudden the barriers to entry have dropped so much that your kids could start making Disney movies.
Michael, I got 8 ways to go here. 8 ways to go here. We could do a 2-hour conversation on this. We're thrilled you're with us. And the bottom, I'm going to go financial. I got 60% plus debt at Paramount, 60% plus debt at Warner Brothers Discovery Disaster. I've got 30 plus debt at Fox, whatever. And Disney's debt less encumbered at 21% on the balance sheet. Is debt Iger's salvation to merge for scale?
It's a good question. I think his salvation is getting his cash flow. So, it's Tom. They used to generate $10 billion of cash flow a few years ago. Now they generate about $4 billion of cash flow. I think his opportunity is really to focus you on the park business and fixing streaming. Here's to your point, because he owns parks, his balance sheet is not the same risk of the other companies you mentioned, right? Those balance sheets are going to be the story the next couple of years. I think Disney can work their way out of it by focusing on parks and fixing profitability on streaming. So to your point, he has flexibility here. And I do think the story is, if you look at the value of resort assets, where they move to, Disney stock is cheap if you think about it as a different type of company led by resorts and hotels and parks. That's what I think Bob's looking at the next couple of years.
Michael, I've got to squeeze this in. You're in the perfect seat to ask this question. It said in November 2022, everyone hates Facebook, Meta, and Mark Zuckerberg.
Yeah.
It's now in the summer of 2023. Everyone loves Facebook, Meta, and still hates Mark Zuckerberg. Is there something that the Walt Disney Company can announce in the same way that Zuckerberg did in early November to talk about the year of efficiency to turn this name around more quickly?
Yes. And John, you remember I was on air with you guys defending Facebook and Meta the whole time, right?
Yeah. Well, you got 30 seconds to tell me now.
Yes, because the reality is their streaming businesses lose too much money. Netflix is worth $200 billion. Disney streaming businesses are worth $10 billion, right? The focus is fixing profitability of streaming. Let parks continue, but fix streaming profitability, get those linear networks off your books, and people look at this and say, wow, this stock is really cheap. So we have a buy on Disney. I think next 12 months, we come back 12 months from now, stock's higher from here because of what you said.
Michael, thank you, sir. It's what you said, not what I said. Michael, thank you. Michael Nathanson of SVB Moffett-Nathanson. The great call on Meta and what developed over the last, amazing what's happened there over the last 9 months, right?
The degrees of freedom that Mr. Iger has is just about zero. I mean,
Tough spot.
Although I figured out Barbie, they just do it with Bambi.
Okay. Would you like me to say something back to that?
No.
Okay.
Barbie, Bambi.
I'll be stepping away now.
Slowly or quickly.
Bloomberg Surveillance. Good morning, everyone. Lisa Abramowicz and Tom Keene. John Ferro on assignment, getting ready for the next hour here. We got the countdown clock going here. We're 24 hours and 15 seconds away from what matters. Lisa, did you know there's an inflation report tomorrow?
That's what I've heard. And I've heard it's going to be really important, a CPI report to talk about how much progress we've made and does this turn up the heat to raise the bar for the Fed to go again or just stay on hold, which seems to be the desire.
15 minutes for Global Wall Street to stay with us. We're going to go to Kathleen Bastiancic, all of her good work at Nationwide. But first, we get a briefing with Michael McKee. Michael, yesterday out on X. See how I did that? there was a zeet from Jason Furman of Harvard University.
Man, you really adopted the
Jason Furman. Yeah, my fever's down. It's under 103. I'm back down to 101.
Might as well have some more tang.
We'll have some more tang. Michael, he tore to shreds the math of Atlanta GDP now, 4.12%. Michael McKee, is it just a marketing series? Is it just a thing that we really shouldn't pay attention to?
No, it is a thing to sort of track where we are, but it only tells you where we are at the moment. This is just the beginning of the second month of the quarter, so we're only getting data from the first month of the quarter, July, and we've only gotten a half of that or part of that, so the number is not going to be based on any kind of end of quarter reality. So you don't look at it's sort of like looking at a presidential election poll a year ahead of time. I mean, it's not going to tell you who's going to win because you don't even know who's going to be running. But we can say that the Atlanta Fed nailed it in the last quarter. Their final figure was 2.4. We got 2.4.
Well, we're looking right now at the potential for year-over-year comparative figures that are going to be easier to beat. And this is sort of the key question that I have. Do you buy arguments that we could see year-over-year disinflation now, but it could be reinflation later in the year as some of the comps become easier to beat?
Well, I think it's a little bit different. I would put it differently because we're not going to see probably disinflation now because we have such easy comparisons to last year. Last year there was zero inflation. Inflation was measured at zero on a month-over-month basis in July of last year. So any inflation is going to push the year-over-year number up, which is why we are anticipating a slight jump up to 3.2%, 3.3% for the month of July compared to 3% in June. But after that, we don't know for sure what the impact of energy prices is going to be on the headline. It is going to have an effect going into the next months. We'll see headline inflation go up, but everybody's going to be, the Fed is going to be focused on the core. And one of the things that we are looking at is instead of the year over year, you look at the month over month to see if progress continues to be made. And we've come down a lot from the 0.5, 0.4 numbers on a month-over-month basis to 0.2 last month. 0.2 is what's forecast for this month. The Fed would see that as progress.
Some people will say that in the housing market, which accounts for a significant portion of the CPI, you are seeing the cool down more broadly in rents, even though some people say you have seen a bottoming out, you haven't seen a reacceleration. How much in the housing sector, as well as in the auto price sector, some of the key features in the CPI report and in the core, how much does that seem to be stable and in a stable way, staying fairly constant and not really rising?
Well, they're not rising anymore. They are falling, and that should be some good news overall and help push the core down some. Used car prices at the wholesale level, everybody looks at the Manheim auto auctions people data, they're down 11.6% on a year-over-year basis. So we're anticipating used cars will push down on it. Housing has been going down. It's been what everybody's been waiting for, but it's been very, very slow. And to get back to your earlier question, Lisa, because there's nothing for sale, home prices have gone up. And now, with what we've seen in the bond market over the last week, mortgage costs are way up again. So that'll take a year to get into the system, but it does present some inflation down the road.
Where I wanted to go. You and Kathleen Bostjancic are fancy people, and you're looking at 3-month annualized in 1 year and trim mean Dallas and all that. Our listeners and viewers, they don't look at it like that. To them, it's 2-year inflation or 4-year inflation. I've got the 8-quarter moving average of pandemic inflation, lofty. This is headline inflation, 6.6%, which I think feels to the angst of all the mail I get from our listeners and viewers. They seem almost unattached to you and Bostjancic about what price change is doing.
Well, we're sitting here talking about whether prices are going up or down in a month and whether they went up 0.2%. The average person is going to the grocery store or to the department store and saying, these prices are higher than they were a year ago.
Or 2 years ago.
And when we talk about disinflation, we're talking about the rate of inflation going down. We're not talking about people actually cutting prices. I mean, it'd be nice if we did, but people are not cutting prices. So people are looking at what it used to be, because maybe haven't gone back to school shopping since last summer, so now they look at what school close cost. I'm sure Lisa's doing that. And they're saying, we've got inflation.
I'm going to suggest to President Biden and President Trump 6.6% 2-year headline inflation is the emotion that's out there. We'll have all that data and the excellence of Michael McKee for you tomorrow at 8:30. Right now, Kathleen Bostjancic joins us, chief economist at Nationwide Mutual. Kathy, am I right that the public here doesn't really care about all this micro data analysis? They're looking at the 1 year, the 2 year, the 3 year pandemic inflation, and it's killing them.
Well, good morning, Tom. Happy to be with you and Lisa and Mike this morning. I think that weighs on the Federal Reserve, not just weighs on consumers, but it is something in the back of all the Fed officials' mind when they think about inflation. Yes, they're looking at the most recent print and they're doing the 3-month annualized, 6-month annualized, but they know that this inflation is really a tax on consumers, especially lower income and middle income households. So, Chairman Powell wants to make sure that, when he looks back and his legacy is assessed, he's not seen as leaving with high inflation. He missed, right? The Fed thought it would be transitory. You don't really want to leave and move on and still have high inflation, as you end your tenure there.
Kathy, are you in the camp who believes that this CPI report will be really important in order to determine whether the Fed hikes or stays put? Or are you in the camp that probably it will not give us a whole lot of information? It might even be a head fake for reinflation that we see later this year.
Yeah, so timing is always difficult. I think for now we are in a disinflationary trend, and I do think tomorrow's report and the subsequent report after that will be important as the Fed convenes in September to decide whether, to keep, raise rates again or to be on hold. But you're right. When you look out, the problem is there's quite a long lag. So when you look at home prices, they lead the rental inflation by about 1.5 years in our modeling. So yes, eventually it could start to turn back up, but it's a long time before that. But yeah, we are concerned about that. What I'm also concerned about is the fact you were talking about this earlier with GDP growth. We seem to be accelerating, right? We 2% Q1, 2.4 Q2, and now, at least 3%. We're not quite at the 4% the Atlanta Fed is, as Mike rightly said. That's kind of a snapshot of current data. But the economy accelerating or certainly not slowing below potential, what the Fed wants. I think it's tougher to bring down inflation.
From an economic perspective, we were talking about wage inflation with respect particularly to the union organization and what we saw with UPS and some of the wages. John wants to get a $170,000 job driving a truck, as he informed us this morning. Does that factor into your estimates of wage inflation, of the dynamic of how much you could get an acceleration in the economy as wages continue to increase? Is that something that you're looking more closely at as you do hear more of these organized labor discussions?
Yeah, I'm concerned. I'm concerned that not that wage growth is the strong wage growth is causing inflation, but that it's a barrier to lower inflation. Now, certainly, it's great for workers to get their share of the income pie, but it comes at a time where we have these inflation pressures. And again, it's just a barrier to lowering it. So I think it makes it more difficult, keeps the Fed more in a hawkish tone or mood, and may even lead them to raise rates further.
Kathy, away from rent and housing, that's what we talked to, particularly in New York. We're really focused on it 24/7. What's food inflation doing? What's auto inflation doing?
Yeah, so food inflation has come down quite nicely since the peak, especially right after the outbreak of the Ukraine-Russia war. And that's encouraging. Now, there's still concerns, right, if there's some kind of blockade and what happens with wheat prices. And just in general, there's still, I think, a fragility and uncertainty about, if there could be disruptions. But in general, food inflation, we should be key, as Mike said earlier, inflation's slowing, but we're not seeing outright declines. Now, the auto sector is different. We are seeing used car prices outright decline, and that's welcome news for consumers and also for inflation measures. But how far that goes is key. We may see some outright declines, but we're still seeing a supply-demand imbalance in the auto sector, meaning auto companies, when they do produce and supply comes online, we're seeing demand exactly match that. So I think there's still upward pressure, again, resistance in the auto sector,
Right.
especially for new autos.
Remind us as we end this, Kathleen Bostjancic, the inflation series that matters to Chairman Powell. Which is it?
So it is core inflation, and I would say it's super core inflation. So that's core inflation less the rent. And the reason being that rental inflation, even when we model that, should come down very sharp. We think it goes from 8% at the peak to about 5% by year end. But that is baked in. They want to see what's happening to service prices elsewhere, outside of rental inflation.
Great brief. Kathy Bostjancic, thank you so much here. We're 24 hours away from this incredibly important report. Lisa, what stuck out to you there? I mean, what was the thing that mattered to you there?
Just the difficulty in gaming out the various elements of inflation. Housing in particular is the real mystery to me. I've seen some reports saying that rents continue to come down, and the rent equivalent owners inflation metric that they use for the CPI is a little bit strange and lags. But at this point, you also do see rents reaccelerating. This, to me, is a very tricky moment.
It's a tricky moment. The Economist had their Carrie Bradshaw index this week. They published it 40 cities, and it's the median wage. Their serious index, median wage compared to a studio apartment. And there's sort of 20 cities in the game, a bunch of people, a little elevated, and then there's New York. It's like a moonshot of unaffordability. Right now, Standard & Poor's 500 up 0.2%.
What really caught my attention was Roblox, because everyone's
explain this. I do know it, but I don't. Help me.
So basically, it's a platform for, I don't really understand it either because I've never actually spent time on it, but different games that are all loosely affiliated with the same platform, and they can program your own. You can program your own games, or you can play on other people's, and it's interactive. The shares are lower by 8.3% because people are spending fewer hours. The hours engaged were 14 billion. Versus the estimate of 14.4
that was just
billion.
At the Bramah House.
I know, exactly. I mean, I've looked at this and I've got to be honest, and no offense to them, but I was like, wow. I mean, it's not the worst thing in the world that people are using it less. Although,
and I'm deficient on this. You know why? I won't let the machines in the house. It's the one thing I put my foot down on.
What about the phones?
The phones I have, it's a disaster.
They're on the phones.
And all of it.
But it's all on the phones.
The Wii, and Joe Coy talks about Wii, and I don't have any, I'm ignorant.
The Wii is like an exercise routine, though, where you can do tennis or whatever else.
Plays with his mother.
Yeah. But all I know is that, this sort of question of what is the correct usage for some of these companies in the post-pandemic reality, when people don't have literally 14 screens in front of them to try to take their mind off the fact that they have nowhere to go.
I got like 6 books going right now, and one of them is a cricket book by Satya Nadella. It's really, really quite good. Are games addictive? Is Activision Blizzard's, is this addiction like cigars or whatever?
Well, China thinks so. China thinks that even the iPhone is addictive, or just smartphones in general. Did you see they're like limiting the use of kids to use it? And I think there's going to be a lot of really interesting.
I thought it was a spin-off of Clorox. Good morning, everyone. This is Bloomberg Surveillance.
We are seeing, that the effects of, let's say, Bidenomics, or, all the initiatives that the Biden administration has undertaken, those effects are still filtering through. They probably will continue to filter through. We think inflation is going to come down. It's going to come down meaningfully. Services spending is still strong, but it has decelerated. If you look at food services, if you look at recreation services, those are the things that the Fed is looking at.
What we do is speak to authorities on these statistics that matter. Rubila Faruqi there with High Frequency Economics, as we just spoke with Kathleen Bostjancic of Nationwide on this important inflation series tomorrow. I should say Michael McKee, of course, will go beneath the headline data at 8:30. There's a singular headline out, which is of your certain vintage. The word normalization speaks so much. This is from the Wall Street Journal moments ago. The United States and the Kingdom of Saudi Arabia agree to broad terms for Israel normalization. The story is breaking right now. We'll have much more on this. For perspective on this, I can't say enough about Francine Lacroix's effort with Mr. Netanyahu in the recent days. It is hugely controversial, and there's no other way to put it. But Francine Lacroix with a primer with Benjamin Netanyahu on Israel, on domestic affairs, on the judicial system. But Lisa, to see the simple headline here, there'll be much more on this. To go back to my memory of the 67 war in all of the history we've all lived, an extraordinary single headline of agreement between the United States and the Saudis.
Especially at a time when a lot of people had expected a ratcheting up in tensions between Israel and Saudi Arabia, with Saudi Arabia being critical of some of the recent moves over in Israel. Israel trying to, at least Netanyahu, trying to put forward some sort of ratcheting back of what they were talking about in terms of reforming or changing the court system and making it a little bit less independent was the fear.
Oh, there's the headline there from the Journal, and we'll move on from that right now. One of the things that we've been talking about, Lisa, and I've been hugely remiss on this, is to get clarity on commercial real estate. There seem to be generalizations out there by people that aren't experts, and the fact is that maybe we should speak to somebody that actually, heaven forbid, knows what we're talking about. And we'll have to see on that. But to me, the heart of the matter is CRE. And do you just look at the office trauma of work from home, or is there more going on than just work from home? To me, that's the arch question.
And is it just isolated to the office space sector? There was a story in the Wall Street Journal over the past couple of days talking about how buildings, rental buildings, single family, like multifamily housing units, actually are seeing huge declines in valuations right now. And this is tied in part to the story of work from home. If there are people who don't want to live in city centers. But there also is this question of, is there something else going on? Every person who I've talked to say, well, there's a distinction. You've got, for example, the warehouse space and other space that actually is holding up its value quite considerably. But it feels like there's something going on when you look at mortgage rates of 7.4%.
I look at the mortgage rate question, and to me, it's a 30-year discussion. And of course, we all know about where fixed rates are now. And somebody got one. John Farrell's apoplectic about this, about people with a 1% mortgage. But the bottom line for me is a commercial real estate redo, the refi, the recommitment is a 5 or 7 year timeline. I'm speaking as an amateur. It's a much shorter timeline where I think the optimism here is it gets solved quicker. Joining us right now, Alexander Goldfarb with Piper Sandler. Thrilled he could join us today on CRE. Alexander, I want you to speak of the stereotype of the moment that's wrong. What upsets you most about the analysis in the media of CRE?
Well, first, thank you for having me on this morning, and appreciate it. I'd say what is most troubling about commercial real estate, and certainly we've been writing about it at Piper Sandler for quite a while, is people will make broad generalizations and they won't really dig beneath the surface. So they'll make a blanket statement, sort of drop the mic, walk away. And I'll give you two analogies.
Please.
Years ago, people said the mall is dead. And they would go and they'd show some derelict mall in some, small market or some, tertiary place that had, long since ceased being relevant. And then the same at Christmas time, they'd show up at like the Westchester, right, or Roosevelt Field, which are Simon assets, and show all the kids and all the families coming out to meet Santa. And it was like, wait a minute, what's going on? Same thing happens today with office. Everyone says office is dead, office is no more. And yet, if you look and say, wow, SL Green sold a 50% stake in 245 Park Avenue, and everyone is blown away and amazed that people are interested in office. And again, this is the same thing. So people need to look between real estate and figure out what is legitimate, desirable real estate and what is the stuff that is fading away.
Alexander, Lisa wants to talk to you about the realities out there for the people of our cities that seem to be flat on their back from CRE. I want to talk about the landlords. Do they have an adjusted internal rate of return? As the market clears, is it then business as usual, or is it a new territory for landlords of CRE?
So I'd say for CRE, the biggest change that's occurred over the past decade is, one, people realizing that it's not just the market that wins, it's the product. So that's first. Second is that development is a lot riskier than people realize. And third, that the best laid plans, often go awry. So if you take it in that order, years ago, New York was the end-all, be-all. Now people realize that the Sun Belt is an amazing spot to invest and make money in real estate. At the same time, people are realizing that you have to own the right assets. So you've had new people who go down to the Sun Belt and then are amazed that there's supply. Meanwhile, people who have invested in the Sun Belt for decades understand how to work around that supply. Same thing in the urban areas. People, as you know, in Manhattan, people paid big numbers for real estate and they get left holding the bag. Meanwhile, others have been successful for decades investing in Manhattan real estate, making a lot of money. So again, it's that market knowledge. And I think over the past decade, the REIT investors and the REITs themselves have really come to terms to better isolate and understand that dynamic in a way that didn't exist, 20, 30 years ago when REITs were really coming about out of the RTC days.
Is the money from China, is the money from Japan, is that drying up that used to come into the U.S. and buy commercial real estate?
So the money that came from China, everyone's making headlines because the Japanese this cycle. They think about the 80s, Rockefeller Center, Pebble Beach, et cetera. Well, the Chinese were the Japanese of this cycle. Right now, the Japanese look to be the smart money. They haven't invested really in the U.S. in decades, and they're coming in and sort of picking off at sort of low, post pandemic prices. The Chinese definitely, look at the prices that were paid even for, the stake in 245 Park, for the Waldorf. You can go down the list. The Chinese certainly paid top dollar. But again, a lot of overseas investors, it's really a reallocation trade, and that always can do wonky things. So take Latin America and Miami. As we know, for decades, Latin America comes to Miami not because of value, but as a store of value. And unfortunately for the Chinese, they were pretty aggressive in coming to the U.S. looking for that store of value the last cycle, and we've all read the headlines of what's transpired.
Just real quickly here, do you think that people are overestimating or underestimating the pain that is likely to come down the pipe when it comes to commercial real estate?
So I think it's both. On one hand, if you look at what happened post the credit crisis, there was a lot of fear of peak CMBS that would overwhelm the system. It didn't happen. The condo loans worked out. There was Course Bank that got worked out. But most of those loans, got resolved. In fact, the big benchmark, GG10, I doubt many people know what even happened to that CMBS issuance. So when you look at today's, and there are a lot of stories on it, when you look at that, yes, there will be loans that go back, keys that go back, because those buildings are not desirable and there are no economics, and it's not worthy of investing. On the flip side, you have what Vornado did recently, where they worked to restructure a loan on one of their high street retail assets. So again, if there's value in the asset and if the economics make sense, the lenders and the borrowers will work it out. If not, it will go back. But let's be clear, no bank wants to get the keys to a derelict asset, right? They have every reason to want to work with the borrower. And by the way, the special servicers, they make more money the longer the deal gets wrapped up and goes back and forth. So there's a vested interest in the special servicers to try and work it out with the borrowers as well.
Okay, we're out of time. Alexander Goldfarb, brilliant primer there on CRE. We don't do enough of this. He's with Piper Sandler this morning. I feel terrible about this because it's a huge part of what we do in economics, finance, investment, and we do CRE sort of as an afterthought. Right now, it's not an afterthought.
Especially given that Moody's thinks that this could actually lead to fundamental weakness at a whole slew of regional banks, as we heard yesterday.
Tomorrow, we've been waiting for this all week. The week begins tomorrow at 8:30 on Thursday with an inflation report. We hope you will attend. Michael McKee will be in to give us important perspective, always with the best guests we can find for you. This is Bloomberg Surveillance.